of the guidance that we're getting from Chair Powell and from the Fed. Yes, they have laid out a path in the dot plot, but really what we're talking about is a 3 to 6 month, time period. It's very difficult right now to forecast anything beyond, the next 3 to 4 months. And that's been very clear in, how quickly things have changed, and all the interconnections that we're seeing in terms of what's happening within the lockdowns in China, supply chains, what's happening with the war in Ukraine. So I do think that we are in a situation that is unique. We are data dependent, and as much as markets would like to get ahead of what central banks are dealing with, it really is a matter of how the data evolve, and that is going to dictate policy action.
Let's talk about some of that data, including what's coming tomorrow, which is expected to read through to the lowest unemployment rate going back to the 1960s. Is this a good thing or a bad thing for the Fed?
It depends on the reasons for why it's happening, right? I mean, if you are seeing participation not go up and the unemployment rate continues to go down, then that feeds into wages, then that's certainly not something that they want. So I do think that, our base case, our baseline remains that we are going to see participation rise. What we're seeing on real disposable incomes, real wages, that is still not keeping up with price gains. So I do think there is going to be some, on the margin, people are going to start coming back into the labor force. And, so I think that dynamic is going to play out over coming months.
Rubila, great to catch up with you. Rubila Faruqi there of High Frequency Economics. Look, TK, you and I have a different perspective on this. My view is that they weren't data dependent at all. They looked at the data, they ignored it. They had a forecast that inflation would ultimately be transitory, and they depended on that. They told us they would be data dependent, but they were still forecast dependent. And Governor Qualls has said it now on the record. The former Fed official said this: we would have been better served to start getting on top of it in September. That was hard to do until there was clarity as to what the leadership of the Fed was going forward and what it was going to be. Now, Tom, you tell me, does that sound like a Fed that has been data dependent? That's a former Fed official saying that.
Yeah, I would agree with it. It is a former Fed official. I would suggest, John, that you make it up as you go, and they're going to rely on data. And the answer, with the war of Ukraine, they did not see that coming. They did not see the leg up in agriculture products, et cetera. No one else did as well, to be honest. And the fact is they've been given news offense, which forces them to extend out the timeline on inflation. No question about that. I remember crystal clear, John, the day Ellen Zentner was in some ways criticized for framing inflation as a 1-quarter, 2-quarter event. And that's now, not to speak for Ms. Zentner, but that's now 9 months, a year-and-a-half event. Everything's been extended because of the war.
Tom, do you really think this is down to the war in Ukraine?
I think that, as Paul Romer said yesterday, we're enjoying 2, 3, even 4 once-in-a-lifetime events since August of 2007.
I agree with you. It might have exacerbated some issues, Tom. But the idea that that's been a big factor compared to what we had already seen going into the end of the year, the start of the year.
These trends were in place. I looked carefully at log diesel today, and there's no question these trends were in place, as Mr. Quarles says, back in the autumn of last year. There's no question about that. But on a log basis, they have surged across any number of series coming off of February 24th.
What's important now, I guess, is where we are and where we're going. And they've normalized 50 basis point rate hikes, Lisa. We've had one. We're set to get another 2.
Yeah, and as frankly, Bank of England follow, I was really struck by Philip Lane saying that Europe is unlikely to revert to below target inflation in the near future. It just speaks to the shift, the longer-term shift, regardless of the conflicts or not, in inflation expectations over the long term.
We'll catch up with David Page shortly, the head of macro research at AXA Investment Managers. Looking forward to that. A little softer this morning after a big rally yesterday. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Elon Musk has received more equity commitment lenders for his Twitter deal, according to a filing. Those letters provide for about $7.2 billion in new financing commitments. The investors include Binance, Brookfield, Fidelity Management, Qatar Holding, and Oracle billionaire Larry Ellison. It's the Federal Reserve's most aggressive action in decades to fight inflation. Fed Chair Jerome Powell and other policymakers raised interest rates by a half percentage point and signaled that they would keep raising rates at that pace over the next couple of meetings. Powell implied that the moves could hurt economic growth. OPEC and its allies are expected to ratify another small increase in oil production when they meet today. Their meeting comes a day after the EU announced its plan for a phased ban on Russian crude that sent oil prices surging more than 5%. And Shell posted its highest quarterly earnings in more than a decade. Profit was boosted by high oil and gas prices that more than offset a $3.9 billion accounting charge on Shell's planned exit from Russia. The company says that distributions to investors in the second half could be more than 30% of cash flow from operations. And the price of wheat gained the most in more than 3 weeks. One of the world's largest exporters, India, is considering whether to restrict shipments. This is at a time when there's growing concern about a food crisis. A heat wave has hurt Indian crops this spring. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy.
Chairman Powell there of the Federal Reserve from New York City this morning. Good morning with Tom Keene, Lisa Bramford and Jonathan Ferro. Equities tracing a little bit lower, down by 0.6% on the S&P, and the Nasdaq 100 down by almost 0.75%, just after a monster move yesterday on the S&P, up by almost 3 percentage points, the biggest one-day pop going back to spring of 2020. Jonathan Goldberg, Credit Suisse, just out, lowering his price target to 4,900 from 5,200. Still seeing upside from here of 13.9%. I'd suggest the cut to the price target's not the story here. It's the upside he still foresees in this market of 14% almost, Tom. And that's a pretty big call from where we are.
It'll be interesting to see how people adjust. Some more by language like Dudley, and others like Hollenhorst. You wonder, John, how they tweak into the weekend.
I agree. I'm looking forward to catching up with John a little bit later, Tom.
Yeah, it's going to be interesting as well. Doug Cass, listening in Florida, comes to the defense of Jonathan Ferro. Folks, this is Latin. Here's this Cass. John is correct. The Fed is ex ante. Ex ante is Latin for getting out in front of the theme, the data, the trend, the equation, and ex post, which is codified within Fed history, Meltzer and Bernanke and the rest of them. Ex post is after the fact. Now, some of you know that surveillance Latin is a really important thing. For example, on my floor here, we do Latin with Tang, and we like use, ipotest etcipere vitrum Tang. But far more importantly...
Can you translate that, Tom?
Yeah, I need a glass of Tang.
Okay.
And then also, of course, we look to the weekend, and of course, we're so wrapped up in the Tots versus Liverpool. You can go as Tottenham, which is with a I don't know the Latin pronunciation there.
Right.
Debit Vincere Van Dijk. I mean, Van Dijk's the key.
I think the whole thing's
Isn't Van Dijk the key for Liverpool, John?
He's a fantastic defender, Tom.
I mean, they got to get by the guy.
They have. But you've got a decent front line too.
I mean, how does Harry and Son, how does Son and Kane
Can we get the Bramo
take
cam
on
up?
Van Dijk?
Can we please get the Bramo
it's
cam
really
up?
okay. It's good.
Hands,
I'm good.
meet
Everything's
heads.
good. Hey.
Is it? Bramo's not happy.
I'm so happy.
Can I
Carry
return
on,
to this
please.
ex post, ex ante?
Yeah, let's go there.
It's not necessarily my view. I think the fact that we have a Fed official, a former Fed official, saying it, that they disregarded the data because of uncertainty about the leadership. I'm just surprised that a bigger deal hasn't been made of that. That is hugely problematic for the leadership of this Fed. If other people hold that view.
And Mr. Cass holds that view, and you are correct. Is it in the zeitgeist? No, but it's out there.
Sure.
There's no question about that as well. Let's get an opinion on this with AXA Investment Managers. David Page was not prepared for this conversation. David, ex ante, ex post, is this a Fed that was distracted last year?
I think it's a Fed that's always been a bit confused about the role of forecasting. Fed Chair Powell has never really wanted to put too much weight on the role of forecasts in his policy. Whereas, of course, a central bank that is committing to inflation targeting has to have a view of what's going to happen in terms of the next couple of years in the economy. And I think possibly the sort of leadership issue was one of that. How much focus to put on where data is now, and how much focus to put on where they expected the economy to move once the policy changes fully work their way through the system.
Ultimately, David, could you ever be completely data dependent? Isn't the essence of transitory a forecast, ultimately?
Yeah. I think you have to have, and I think a central bank that's setting monetary policy that famously works over 18 months to 2 years to fully affect the economy, you have to have an element of forecast and anticipation to your policy moves. And to move just when you see the data would be to move too late, and that's sort of what central banking has transformed to over the last couple of decades, and perhaps rode back a little bit more recently.
David, how did yesterday's meeting change your view, if at all, about how the Fed's going to proceed and what you want to own?
So how it's going to proceed, I mean, it was fascinating to me that Fed Chair Powell sort of spelt out how this was, the most difficult time to provide forward guidance, and then proceeded to give precise forward guidance for the next couple of meetings. It seemed a very strange position to be in. I think, the data coming out over the next couple of months are going to be key. Payrolls tomorrow, interesting. It's absolutely fundamental to the Fed to get a slower labour market, not just a softening in the economy. It's got to translate to a slower labour market. And depending on how quickly that comes through, I think depends on how much the Fed needs to do. And that then feeds into the question of what one owns, because ultimately the Fed's tools are monetary policy, but they transmit through financial conditions. And if we're not seeing sufficient slowdown in the labour market, they need to tighten financial conditions further to generate that slowdown. And that means more pain for risk assets.
Where's the biggest asymmetry of risk? Basically, this idea of the Fed being overly hawked, right? That people expect too much of the Fed, or that people are perhaps sanguine that the Fed won't have to go further and faster than currently forecast.
To our minds, we think that the Fed is likely to stop before it gets to the rates that are there. We're very clearly seeing a Fed that at the moment is absolutely focused on inflation, and that is quite a big shift in where they've been over the last sort of 6 to 9 months. But that's not to say they can't row back a little bit. And if we do start to see the slowdown that we're expecting coming through in the labour market towards the end of this year, then I think the Fed can start to relax a little bit. I think we have to sort of bear in mind there's a little bit of the Maradona element coming through here as well. I suspect the five-year inflation at break-even inflation expectations moving above 260 odd was something that started to unnerve the Fed, and I think they absolutely want to underpin the fact that they've got that they've got inflation expectations nailed at that level.
John, help me here. What is the Maradona element? What help?
The idea is, Tom,
Apologies,
that you fake going one way, you fake going the other, but ultimately you go in a straight line. That's it.
And it's something that ex-Bank of England Governor Mervyn King used to refer to monetary policy. So you don't actually have to move as much as markets expect, because you've signalled that you might, and markets do the work for you. So that's very much something that is basically shaping interest rate expectations.
David Page of AXA Investment Managers.
I learn stuff
I'm not going to hear the end of this.
Show.
Do you not know who Diego Maradona was, Tom?
No,
yes, you do. You do. I don't believe that. I don't believe that. I don't believe you.
Even I know.
I know you know, Bramo. And I know he knows too.
Oh, please, cue the Bramo cam. Bring it up right now.
I mean, honestly.
Very Bramo cam.
Come on,
there we are, more Latin.
You know that Maradona's jersey basically just sold for $9.3 million. That happened yesterday.
Yeah,
I mean,
but so did Taylor Swift's.
I don't know about Tom. No. Okay.
I don't know where to go with this.
Can you get me, John?
Do we have Guy Johnson?
John, can you get me a ticket
Can he take this box?
John, can you get me an NYU commencement ticket for Taylor Swift speaking?
Why is that? I didn't know that, Tom.
That's what Mrs. Keene wants for Mother's Day.
Are they selling those?
I don't know.
I don't think you sell those.
I think NYU will sell it. What's it cost? $70,000 a year, Lisa?
Got no idea.
Surveillance research.
You know.
The news
I'm sure you'll tell us, just as the Bank of England rate decision is dropping in about...
Madonna has a jersey. That's
I've been doing this with you for a while, Tom.
Maradona, not Madonna.
Oh, Maradona.
I'm pretty used to it, but that was pretty shocking. Down 0.6 on the S&P. A Bank of England rate decision coming up.
Vertrium, Vitrum, Tang.
Dear me. You done? Yields up 3 basis points. A 10-year, 296.39. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I do think markets have sort of priced in a lot here.
Yes, equity markets have had a hard run of it in the month of March and now April.
Unless we get a deep recession, there's a limit to how much equities will fall from here.
The Fed looks at the equity markets very, very closely. They don't want to destabilize them.
We could target a stable 4% inflation rate if we wanted to, or a stable 2%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures down 0.7% on the S&P. Yesterday we saw a massive move higher off the back of the Federal Reserve decision. We'll get our teeth into that in just a moment. We need to start with the Bank of England as they move interest rates to 1 full percentage point. From the City of London, here's Guy Johnson.
Absolutely. We've raised, as expected, John, up to 1%. That is the line in the sand, effectively, for the start of QT as well, quantitative tightening. The way that the market is reacting right now, John, this is being seen as a marginally hawkish hike. And let me just walk you through the logic behind that. We were expecting at least one member of the MPC not to vote for a hike today. That hasn't happened. Basically, you've had three going for a 50 basis point hike and 6 going for a 25 basis point hike. So more on the 50 basis point hike side than anticipated, and less on the let's keep things as they are camp. So we are seeing a tick higher in sterling as a result of that, and then a tick lower, which is interesting. Actually, we've moved up and now we're moving down. What we have seen, though, is a significant move higher in terms of yields on the UK 2-year, which is what you're looking at on the screen right now. Now we're going to look at where we go from here. So remember, the market is pricing in hikes at every single rate-setting meeting between now and the end of the year. That's 5. We're looking at a terminal rate midway through next year of around 2.65%. Is the bank going to deliver on that, I think, is the next question that we have to ask ourselves. And then we have to ask ourselves a question around what is happening here with QT. When is it going to start? How is it going to be sequenced? What is it going to look like in terms of the pace of sales on a monthly basis? So all of that is still to be decided here. I'm looking for details on exactly what we're going to see there. But at the margin, John, we are seeing a hawkish hike here. because we've got that vote count being slightly different to what the market was expecting.
Well, Guy, I think we have to talk about the nature of the 50 basis point descent from Haskell, Mann and Saunders. Is that because they have a bigger idea of where rates should end the year, or do they think we should be front-loading just a little bit more? I'm trying to ask the question, Guy, whether the three individuals that ultimately asked for a 50 basis point hike aren't that far away from the two individuals that don't think we need any more interest rate hikes.
Well, I think the front-loading question, I think, is interesting. This is an economy that is clearly going to slow down. That is the concern here. The question is, do we find ourselves in a position here in the UK, John, where if the bank doesn't act and act swiftly, that inflation expectations are going to become unanchored? The bank has this idea that ultimately higher inflation is going to be the cure for higher inflation, and it's going to bring inflation back down to target and below target relatively quickly. Is there a concern within this? And we need to break out the numbers that the Bank of England are giving in terms of expected inflation, Tom, to be able to understand the answer to that question. I don't know the answer to that question. I think we're going to learn a lot later in the press conference and the subsequent interviews.
We're going to stop the show here, folks, because what I see on my Bloomberg screen I've never seen, with John Farrow and Guy Johnson from England, to the two of you, and John, let me start with you. I have never seen this. We have 25 and 50 beeps move, including the giant of MIT, one of our great international economists, Catherine Mann, and I'm looking at growth forecasts that are resoundingly difficult. Bank of England, John, next year goes from a 125 down to 0.25% growth. John, I've never seen a rate hike like this into those forecasts ever.
Tom, Catherine Mann can speak for herself. But I think overwhelmingly there is consensus that this Bank of England is worried about decelerating growth in the British economy. And Guy, that's why I ask, how much distance is there actually between the so-called hawks and the so-called doves on the MPC at the moment? Because I'm not convinced that Saunders, even though Mann might have joined Saunders and Haskell for a 50 basis point call today, that ultimately they want to take it much further beyond that, Guy, because of what's happening with growth.
Yeah, but the danger, John, is that if inflation becomes unanchored, that is going to be an even bigger threat to growth. And the Bank of England finds itself in probably the most difficult position amongst the major central banks at the moment. It does have this deceleration. Panetta over at the ECB today was talking about the fact that the Eurozone is in de facto stagnation. You are definitely seeing that here in the UK at the moment. How do you balance those two issues out? And if you take your foot off the brake when it comes to rates, do you end up exacerbating the growth slowdown as well? Because they see inflation slowing growth down. So if you let inflation go too fast, is that growth slowdown going to be even greater? I think that is the battle that they're really challenged with here.
Guy Johnson from Queen Victoria Street, thank you so much this morning. John Farrell, I got to go to you on this. To me, it's a pressure cooker on the stove that your mother had and you thought it was going to blow up and take out half the house. The pressure release valve here is sterling. Does this kind of set of headlines get you to a 120, a 119 weak pound?
Well, look at what cable's doing. Sterling's weaker by about 1% on the day, threatening to break 125. Lisa, what we're seeing play out here, this division, some saying that maybe we're done here. They don't see the need for more rate hikes. Some saying we should have done more today. It's just the politics, the economics of stagflation, ultimately, that we've got weaker growth matched with higher inflation and a central bank that doesn't really know what to do about it, and a bias for some on the committee to say, okay, if we're going to have to do a lot, let's front load it, then wait.
And honestly, I think that that's really the issue, is it's unclear what they can do, and there are no good options. I think it's interesting that sterling is actually weakening. That's what I wanted to point out, this idea that even though this perhaps was a more hawkish 25 basis point hike, the response is sort of the opposite of what you would expect. And I wonder, again, whether rate hikes can really fortify the currency, whether that's something they even want, right? I mean, a balance of, do you want a strong currency or a weak currency in an era of inflation when you want to boost your economy?
And that's the currency, I think, Lisa, responding to the growth outlook.
Yes, absolutely.
Off the back of the rate outlook, which gets revised just a little bit higher this morning, at least. I want to turn to Sebastian Page on some of this, the Chief Investment Strategist and Head of Global Multi-Asset at T. Rowe Price. Seb, this is a tough moment for central banks, and some people might say they got themselves into this mess to some extent. For the UK, they face upside risk to inflation potentially and downside risk to growth. Your view on what policy is going to look like in that world and ultimately what it means for risk assets?
No, the discussion on the UK is interesting. I like to look at I call it a Bloomberg surveillance measure, the 5-year forward. The 5-year forward inflation in the UK is at around 4.7%. That's high. And compare that to the US, where the 5-year forward is at 3.2%. The signal I'm getting from this is that growth is even more fragile in the UK, and the view is that the BOE won't be able to be as aggressive at the Fed, and that also feeds into the weakness in the pound that you were just talking about.
Will the weakness in the pound actually help the economy or hurt the economy?
Look, it can help in terms of exports for sure, but generally speaking, it also feeds into inflation, which then forces the hand of the BOE as well, and then it gets complicated, right? Look, I think if you step back, you look at the big picture, markets got drunk on liquidity post-COVID. And I know, Jonathan, you were talking about Tom being out earlier this week, and you mentioned a hangover. I don't know if that's the case, but right now we're going through a hangover in world capital markets, and it's been remarkable in the sense of both stocks and bonds being down at the same time.
Sterling's through 125 right now, folks. I'm going to call an important level, 124.50, 1.2450 on weak pound. We'll see if we get there. Sebastian, with your book, you own the high ground at T. Rowe Price on this. John mentions what's it mean for risk assets? What's it mean for stocks? Does the market valuation, if we get a current set of currency depreciations off of these absolutely historic central bank moments, can the stock market adapt on valuation, on multiples, to sustain a level market or even a modest single-digit bull market?
Yeah, really good question, Tom. Look, we entered the year positioned for this in our tactical portfolios. Underweight stocks, and within bonds, underweight duration. And what's interesting is we tend to be contrarians. We look at valuation opportunities. We look 12 months out. So normally, we would be leaning in both stocks and bonds. And what's interesting is not what we're doing, it's what we're not doing, Tom. We're actually buying back treasuries, closing our underweights. We're not closing our underweights in stocks. And I said in surveillance back in November, inflation's the #1 risk for markets. I continue to say this. Inflation is the #1 risk for markets. And the key question that's debated on your show all the time is, will the inflation shock lead to a recession, a growth shock?
Seb, great to catch up with you, sir. As always, Sebastian Page there at T. Rowe Price. We've got a growth shock in the UK, and these forecasts, as you indicate, Tom, are dreadful for growth into 23. Think about where we were at the start of 22. There were some people in the UK looking for a 6 handle on GDP in the UK. That's been revised aggressively lower, and into 23, we've effectively got a Bank of England saying growth's going to stagnate, Tom.
It's not the same economy. It's not even apples and oranges. There's some huge differences here, including export-import dynamics. But John, take this moment, and our American viewers and listeners are going, well, so what? It's England. This could be an American debate 6, 8, 9 months from now, is why this is important. And John, if you get a mix of U.S. GDP forecasts lower, with a Fed that's rising into what, 4, 5, 6% inflation? Yeah. Maybe that's where you get to the equivalent of this morning in May.
Directionally, I think I'd be closer to agreeing. By the same magnitude, perhaps not.
Agreed.
You've got a Bank of England that isn't confident we've seen the peak in inflation by any stretch, Lisa. And you've got a Bank of England that is effectively saying growth is going to get pretty bad. And a central bank that is totally divided about what to do about it. I would love right now, not to hear necessarily from Governor Bailey, just the 3 that dissented and looked for a 50 basis point move, whether that's just about front loading and then they are done after that, or whether they're going to be pushing for hikes through the rest of the year because of where inflation is. We've been worried that we'd have a Federal Reserve at the end of this year that would have to choose between growth supporting it and inflation curtailing it. That's the decision, Lisa, the Bank of England has to make right now.
And this has to do also with the supply chain disruptions and exogenous shocks and how they handle it, and whether they actually take the view that the only way to resolve some of the surging inflation is simply to curtail demand. And if they continue to curtail demand, they're going to take that road. I just want to point out that home energy prices rose by another 40% in October. This is one of the headlines coming from this, just to give you a sense of what the pressures are. So what will hiking rates actually do to really curtail energy shocks, right? This is all about dampening demand at a time when already post-tax disposable income is declining at an accelerating pace. This is a bad recipe. They are taking one stand. The Fed is not trying to go that same route.
Just these numbers from the BOE, from Threadneedle Street. TK, I've got to say, I don't think I've ever seen it like this, to see these kind of forecasts.
Yeah.
To say double-digit inflation, we could hit 10%, and to say in 23, the economy could shrink.
This is absolutely original where we are right now. This is in none of the textbooks. I'm sure there's some historian that's going to tell me in 1872 it was like this. John, I don't know. I've never seen what's on the Bloomberg screen right now. John, can we say sterling is yet to get a bid 124.77?
Yeah, that doesn't look good. What a call from Kit Jukes of SocGen.
Yeah, I'll
before this
say.
Bank of England call. Sterling right now, $1.24.
He thinks Tottenham will beat Arsenal.
75. Andrew Sheets and Morgan Stanley coming up in the next hour from New York City this morning. Good morning. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. This week, April jobs are in focus.
It's a very, very good labor market for workers. The demand for labor, obviously, much stronger than the supply.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
As long as the numbers hold up, the Fed is going to feel encouraged.
Then 75 in June is certainly not out of the question.
To me, the question is, are we fully employed?
The elephant is the war in Ukraine.
The April Jobs Report, Friday on Bloomberg Television and Radio.
If that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. If higher rates are required, then we won't hesitate to deliver them.
That was Chairman Powell. That is so yesterday. Let's get to the Bank of England. What a move we've seen. And let's hope for Chairman Powell this is not in his future. Sterling, negative 1.4%. Cable, 124.57. A 25 basis point rate hike. That is not the news. There were 3 individuals on the MPC looking for a 50 basis point rate hike. They didn't get it. But look at these forecasts and look what they would have been hiking into if they went 50. Yeah. They believe that inflation could peak at 10.2% in the fourth quarter of 22, and they see GDP contracting 0.25% in 2023. TK, that is a mess of a decision from this Bank of England.
It's a mess of a decision, and you wonder where the economic theory is, whether it's out of LSE, Cambridge, Oxford, MIT, whatever. Stay on the screen, if you would, on television. On Bloomberg Radio, the way you look at sterling, and every pair is different, is to 2 or to 4 digits. So sterling in the pro world, Global Wall Street, the Bloomberg terminal world, is 1.2459. When we went to break, John, it was 1.247x. Those are called pips, like Gladys Knight and the pips. And we are down 20 pips during the break, John. That's a huge, persistent weakness.
Coming into this decision a few hours ago, Kit Jukes of SocGen published, and he said this decision has, quote, little scope for a hawkish shock. What it does have scope for is economic disappointment. He said cable is more likely, more in danger of breaking 120 than euro-dollar is of breaking parity. And we're not far away, Tom, from it right now, 124.57.
Another meeting has become an historic meeting here at the Bank of England. John, a dumb question. Does he do a press conference?
I believe we do hear from Governor Bailey.
In 10 minutes.
All of us, thank you, Lisa. All of a sudden,
Grandma's got all the timings for everything. You're asking the wrong guy.
I mean, you know.
Lisa knows.
Just sit here with a spreadsheet.
Jack Fitzpatrick joins us again from Washington. Jack, I've never seen the cover of the Washington Post. Such a mess. All the different stories. The Supreme Court uproar. You've got the election uproar. You've got Johnny Depp and what's her name? I'm sorry, Heard. I can't remember. What a mess down there, Jack, right now. Let's focus. What's the Biden administration focused on?
The Biden administration is, I think, trying to turn its focus from a few different issues toward the campaign trail. The immediate stuff, though, that they are clearly focused on and that there is at least agreement with lawmakers that they need to focus on is Ukraine. The question is if they're going to get a bipartisan agreement to help Ukraine to do this bill as soon as next week, the $33 billion requested for Ukraine, how much gets latched onto that? And that speaks to your what you're referring to with the so many different stories that it's difficult to focus on. Yeah. The combination of Ukraine needs, they had a COVID funding bill stall, a series of other things, the Title 42 immigration decision that Republicans have pushed back on and some Democrats. Right now on Capitol Hill, all of those have kind of been melded together, and that's the one thing that might slow down progress on Ukraine. But Ukraine is, I guess, the easiest thing for them to focus on because that's where a lot of agreement is.
And Lisa, I had a brain freeze there. I'm sorry for Miss Heard. I couldn't remember her first name. Amber Heard, Lisa. I loved what she did in Pineapple Express.
Honestly, I've just heard from a Bloomberg subscriber, and I've got to quote them. The absolute irony of telling Jack to focus when we just had a Maradona and Tangram already, and it's only 7:21.
He was speaking for all of us.
Pineapple Express was Oscar-worthy. I'm sorry. Continue.
I'm focused on jobs, not Pineapple Express right now, Jack. And I'm focused on how the White House is going to spin this labor market report tomorrow. And I know this is going off in left field, but this is what I'm focused on. And I think is really driving the narrative in a nation that is really torn between momentum and inflation. How will the White House spin a labor market report that actually is better than expected? Is that actually not optimal for them right now?
They have tried, at least in passing recently, to spin the inflation story and say, look, we were very aggressive in the fiscal response to the recession and the pandemic and got unemployment very, very low. That is not something they have dedicated themselves to as their messaging focus. The president has acknowledged the amount of bad news, and instead of trying to turn everything toward any positive job reports or positive economic news, he has talked about inflation, he's talked about gas prices. So you will probably, if there's good news, you'll probably hear them play up the low unemployment in the country, but they have not entirely dedicated themselves to trying to, I guess, turn the page on inflation. They're pretty focused on addressing the sort of negative flip side.
Hey, Jack, thank you. As always, down in Washington, Jack Fitzpatrick there, just running through some of the political news and economic news of the day. Just got to keep returning to the Bank of England. They are everything the Fed fears it will be months down the road. Everything. This is everything that people worry the Fed could be.
I said that, John. You weren't
6 to 9
listening.
months. I was. I replied to it. That's why I'm going back to it.
Oh, thank you.
Let's talk about these forecasts. 10.2% the fourth quarter of 22 on CPI. In 23, an economy that's contracting by a little bit. But let's face it, you've got a central bank saying the economy is going to contract. You know how rare that is, Tom? A year out for them to tell you that?
I've never seen it.
It's just not something you typically see.
Yeah.
And a committee really divided on how much we needed today
and
whether we should pause now.
So what happens at this press conference in 6 minutes? I mean, is it like a Powell press conference?
The challenge that any central bank leader has in a news conference like this is to try and reflect a consensus when there isn't one. And he's got to try and do that today.
Where's the consensus? I don't see it.
There isn't one.
Is this voting really like what the Fed is, but the Fed, because of Greenspan's too polite
so
to have
this is a bit
dissent?
more nuanced, Tom, so give me a second.
Please.
I'm not sure how much distance there is between the two that want to pause rate hikes and the three that wanted a bigger hike today. I wonder how many of those three, if they'd got their 50 basis points, would have also said, we need to pause rate hikes. It's going to be interesting to see if we get some clarity from Governor Bailey on that. We also have to have a deeper understanding of their reaction function going forward from here, Lisa. If growth really disappoints, yet we are going to see CPI prints like that, are they done?
Well, and is this a concession that inflation is the biggest concern and that the only way to curtail it is to send the economy into recession, that it's going to go anyway, but to then basically push it into something that lowers demand?
No banker ever wants to send their economy into recession.
Nobody wants to, but if your priority is inflation and you have a shallower recession in the near term versus a longer term, deeper recession, that's actually something very much in the zeitgeist.
Another question, Tom. How does the Chancellor respond to these forecasts?
I don't know. My emails.
What can they do on the fiscal side?
John, my email's heating up here, and it's over Madonna here in this jersey. Thank you, Lisa, for the $9 million number on the jersey. I mean, I'm looking at Madonna and the $9 million jersey. I'm sorry, John, it works.
Okay. I'm not responding to that. I'm letting that go. And for our audience on radio, you don't want to know. Futures, negative 0.6% on the S&P. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City this morning. Good morning. We retrace lower, just a little bit negative on the S&P, down 0.7%. On the Nasdaq 100, down 0.9%. Hard to take these moves too seriously off the back of what happened yesterday, which was a massive breakout on the S&P by almost 3-4 percentage points. The biggest one-day pop going back to spring 2020. In fact, around about 2 years ago. The story in the bond market looks like this at the front end of the yield curve in the Treasury market. Powell burying the prospect of a 75 basis point rate hike, and yields came aggressively lower. This morning up by a couple of basis points to 266.47. And some people confident with the idea that for now, the story might have peaked at the front end of the yield curve, given the equity investors' confidence that maybe we can get a bigger squeeze than what we got yesterday through the next several months. We'll see. But for me, the big story right now is on Threadneedle Street. It's in London, the City of London, over at the Bank of England. This is what you do not want to be when you grow older. You do not want to be the Bank of England if you are the Federal Reserve this year. This is everything the Fed and investors fear. Upside risk to inflation, calling for double-digit inflation year-end, a peak of north of 10%, downside risk to growth, calling for a contraction in GDP in 2023, a divided committee, and this story right here, sterling on a day where we get an interest rate hike, negative to 124.42, negative 1.5%. And I have to say, Tom, a news conference with Governor Bailey that's going to be absolutely fascinating.
Yeah, it's gone from interesting, folks, to historic, and I will say that. And I really want to make clear, John, talk to me a little bit about this with a 124.41. I mean, it's not Brexit kind of moves and the sweat around that moment in June a number of years ago. But, John, what is the 123 sterling if we get their signal? It
signals some real economic pain. And that's what Kit Dukes of SocGen was talking about this morning. This is about a central bank hiking into economic weakness. And this, how it's playing out, Tom, is a movie that the ECB will be watching with their hands over their eyes. This is something they don't want to see either.
John, explain this to us. As Governor Bailey, a wonderful gentleman, met him a number of times over in London, sits down at the press conference. That is not Governor Bailey on our radio, but we're doing the introductions here to the gentleman. John, let's just do the compare and contrast of this with Powell and Lagarde. Why is this press conference different?
It is different, Tom, because they've had to hike interest rates for all the wrong reasons at a time when growth is going to get a whole lot more painful. Governor Bailey, I think this is probably one of the hardest news conferences he's had to do, Tom, for a long, long time. In fact, since he's had this position, I think this is as tough as it gets for this governor.
Well, it's going to be interesting to see. And folks, again, the visible descent that you see there, very much different than the Federal Reserve System. John, on the stock market, futures at negative 31.
Yeah, just a bit softer after the big move high yesterday. We'll return to this story and catch up with Guy Johnson of the City and bring you the headlines from that news conference on Threadneedle Street. Let's get you some movers, though, and catch up this morning with Kaylee Lyons. Morning, Kaylee.
Good morning, John. Well, there are a lot of movers out there this morning, including some positive ones on the back of earnings. Albemarle is one of the big outperformers. It's up about 14%. It, of course, is the #1 miner of lithium, which is needed for electric vehicles. Demand really strong. Price is up as a result, and that is helping out that company with a beat on its forecast. It was also a beat on the forecast for Sunrun. Strong demand for solar products, allowing the company to pass through higher costs, the input costs they are facing, exercising that pricing power. It's up about 12.7%. And not an earnings story, but still an upside mover, would be Twitter. This is an Elon Musk story once again, securing $7.1 billion more in financing from the likes of Binance, Brookfield, and Sequoia. Maybe removes a little bit of doubt about his ability to actually close that $44 billion for Twitter, although still, even with a 1.6% gain this morning, we're at $49.85, which is more than $4 below that deal price of $54.20 a share. As for some downside movers today, Tom, there are a number on the back of earnings, and among them is Etsy and eBay. These are both e-commerce plays, of course, both giving weak forecasts. That pandemic boom in online shopping starting to unwind. They're down 12.9% and 7.6% respectively. And Cognizant Technology, this is an IT services company, cut its guidance for top and bottom line. As for the reason why, the company's saying on the call that it is because of compensation pressure driven by the continued labor, supply, and demand imbalance. Really interesting commentary out of corporate America ahead of tomorrow's jobs report, Tom.
Hey, Kaylee, thank you so much. On Bloomberg Radio and Bloomberg Television on Monday and Thursday, no, we've got Bank of England starting. The first headline from Governor Bailey saying the Bank of England is navigating a narrow path on policy. We're going to navigate quickly here to distressed debt in America. Winnie Caesar joins us now, global head of credit strategy at Credit Suisse, and we'll monitor those Bank of England headlines. Winnie, I look at the Bloomberg Total Return Indexes, full faith in credit, the corporate credit quality market, and where you are, the more distressed market, and I see distressed -8%. Is that a bear market in your world?
Not a bear market in our world, and actually distressed at -8% is a massive outperformance versus regular way investment grade credit and also higher rated high yield credit. So the distressed market is actually having a comparably decent year so far, although negative total returns.
I think we've got some disruption, some technical difficulties here with Winnie Caesar at Credit Suisse. Tom, I'm not sure we're going to be able to reestablish that connection anytime soon.
And because of the moment in England, folks, we'll get back to Winnie Caesar. It's really, really quite good, as is Lisa Bramowitz away from full faith in credit. I mean, very quickly here, Lisa, before John goes back to Bank of England, there seems to be a three-part bond market. Do I have that right?
Yeah, but I want to link the two, right? Because the scenario that the Bank of England is something that's very scary about the ECB, but also here in the U.S., people are watching with a wary eye. What does stagflation mean in terms of all of the corporate debt that's been raised? What if the Fed keeps hiking rates and you get weakness in the economy? And I think that's what's keeping a lot of people up at night. And that's what you're seeing in some of the spreads that are starting to widen out, basically a gauge of how much credit risk is increasing. John, I got to say, though, this Bank of England decision is just
it's just
absolutely amazing.
It's nuts. I think we've got to be careful with the language because they're not forecasting a recession per se. The technical definition, as you know, 2 quarters, successive quarters of negative growth. They're essentially forecasting stagnation and ultimately a small contraction in the economy next year. But I think the bottom line here is this is everything we've been talking about the year so far, which is upside risk to inflation, downside risk to growth, and a central bank that's just caught in a classic EM dilemma. What do you do about it? And at first look, they don't really know. They don't really know. And something Governor Bailey's acknowledging right now is that the peak in UK inflation is going to be later than in other economies. We believe here in the United States that we've already seen the peak year over year because of the base effects. You've got a governor here that does not think we've seen the worst of it, that comes further down the road, Tom. And this is really problematic for them as they look to set policy today.
Yeah, and I think to frame this, John, and this is important, when the facts change, Governor Bailey's going to change. I believe a guy named Keynes said that a few years ago. John, I went and looked at trade-weighted sterling a week or two ago, and to get back to the John Major debacle of the early 1990s, it needs to depreciate about 8%. I don't know where that is, but it's way under a 120. It's not that we're getting there, and it's not that we're gloomy, but the vector is in place for weak sterling as of this morning.
As of right now, we're seeing one of the biggest one-day moves lower in cable since September 2020. Governor Bailey making another headline here, Lisa, talking about the growth. The UK growth expected to slow sharply So there's not some smooth glide path here. They're looking for a sharp slowdown in the quarters ahead.
How do they then justify raising rates? Is it just that they think that inflation is that much harder for the economy to handle and that much more difficult that they will do anything to stave that off in the near term? Or basically, are they saying that if they allow the short-term decline or stagnation, does that lead to a softer downturn and a quicker recovery? These are some of the things I want to hear from him as he parses through this very difficult decision.
Well, again, I think we've also got to think about the other side of London. So this is East London at the Bank of England. Get over to Westminster and think about the Chancellor right now, Tom. How is the Chancellor thinking about this moment as his Bank of England is staring down the barrel of economic stagnation over the next 12 months, staring down the barrel of inflation north of 10%. Governor Bailey saying he recognises the hardship facing many people in the UK. He's unelected and to some degree unaccountable. Tom, for this government, they face a really tough decision. And part of the reason that people like Citi are negative on sterling right now is not just because of this story playing out at the moment, right before our eyes. It's because the fiscal offset just isn't there at the moment. Right. Are we going to see one, and can they deliver one after what we've seen over the last couple of years? That's where the doubt is.
And John, one of the things I really want to emphasize is, folks, people in fancy suits and ties and bow ties get on the plane at JFK. We go over to London and we think that's England, like we go to Hong Kong or whatever and think that's China. John, exports as a percent of GDP in the United States, I'm going to, 11, 12, 13%, whatever the number that is. To the island nation, it's what, 30% of what you're doing? It's a huge, huge difference. And those dynamics, particularly with the continent, we haven't even mentioned euro-sterling dynamics, particularly with the continent. I can't say enough, folks, how it's a different challenge for Governor Bailey than it is for Chairman Powell.
They all have their own unique problems, but they share a similar dynamic at the moment. And we keep going over this. It's downside growth risks, upside inflation risks. We've talked a lot about what this might mean for the Federal Reserve. Will they, won't they experience this in the years to come? For the ECB, I think that's what many officials are grappling with right now, going into June. This is the story they face right now. An economy that, in the words of an official from the ECB this morning, Fabio Panetta, this economy is facing stagnation and an inflation print that is heading in the wrong direction still. And that's the problem the ECB and the BOE have got too, that maybe the Fed does not have. The Fed might have the comfort of getting some inflation prints year over year that start to decline in the months ahead. Governor Bailey is telling you today that he does not have that luxury.
And John, a bit of history here. I remember the moment where Catherine Mann became acclaimed in economics. She's one of the rare people, folks, who's done not one, but two, but three giant things in academic economics. A monograph, John, I'm afraid to say how many years ago, she was like 15 when she wrote it, is a trade deficit sustainable? And that speaks to the $100 gajillion trade balance reported by the U.S. yesterday and the challenges that Dr. Mann and Governor Bailey have.
Sterling right now just about clinging on to 124. That's the pound against the US dollar, 124.11, and down by 1.7% on that currency pair. Guy Johnson's going to touch base with us very shortly to run us through this news conference, and we'll continue to talk about the possible potential parallels further down the road for what might or might not happen here in America. Futures down on the S&P by 6 or 0.7%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Elon Musk has now secured about $7.1 billion of new financing commitments for his proposed $44 billion takeover of Twitter. Amongst the investors named in a filing, Binance, Brookfield Fidelity, Qatar Holdings, and Larry Ellison, Revocable Trust. Musk is now in talks with Twitter co-founder Jack Dorsey on contributing some of his shares towards the deal. It's the Federal Reserve's most aggressive action in decades to fight inflation. Fed Chair Jerome Powell and other policymakers raised interest rates by a 0.5 percentage point and signaled that they would keep raising rates at that pace over the next couple of meetings. Powell implied that the moves could hurt economic growth. And OPEC and its allies are expected to ratify just another small increase in oil production when they meet today. Their meeting comes a day after the EU announced, of course, its plan for a phased ban on Russian crude that sent oil prices surging more than 5%. And Warren Buffett is boosting his bet on Occidental Petroleum. Buffett's Berkshire Hathaway has bought up almost 6 million more shares of Occidental. Berkshire had previously built up a stake of more than 14% of the company. Occidental was the best performing stock in the S&P 500 during the first quarter. And the price of wheat gained the most in more than 3 weeks. One of the world's largest exporters, India, is considering whether to restrict shipments at a time when there is growing concern about a food crisis. A heat wave has hurt Indian crops this spring. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Going back to the 1930s, we have never been able to reduce inflation by more than 2.5 percentage points without inducing a recession.
So even if we don't get close to the 2% target, it's very likely that we will have some kind of an economic slowdown well before we get to the desired inflation target.
Scott Minerd, the CIO at Guggenheim Global, he wasn't talking about the Bank of England. He might as well be. He was talking about the Fed. From New York City this morning, good morning. Equity futures declining by 0.6% on the S&P after a big move higher yesterday of almost 3 full percentage points on the S&P 500. The Nasdaq 100 down by about 0.8%, yields higher by a couple of basis points. The main event, though, looks a little something like this. It's sterling very briefly breaking 124 and having a little look at 123. It's negative 1.8% on the session. All the wrong things, TK, happening in the UK today.
It's amazing where Scott Minerd talks about the 30s, and you wonder what the value of a pound was in the 30s, John. 6, 7, 8 per dollar. Now we're down where we are, $1 and change as well. 123.99 on sterling. Absolutely stunning. We're going to digress for a moment, come back to the Fed and what we observed yesterday off of the Taylor roll and the great separation of the theory and where we are. Kriti Gupta.
Yeah, Tom, a historic day for the Fed yesterday. We had that 50 basis point hike, the first in 22 years. But we have to talk about how we got here, and that really brings me to my chart of the day. The spread between the Fed funds rate and CPI at the largest ever. For our radio audience, stick with me here. Basically, what you see is going back even to the 70s, a steep drop starting in 2020, essentially when it comes to this spread. It begs the question, is the Federal Reserve behind the curve? We hear that all the time in the commentary, but something that really stuck out to me in the press conference was when Chairman Powell himself said monetary policy is working through expectations to a large extent. We can actually see that happening as they address this issue of the spread being so wide, so historically wide. How do they get back to the normal? And that's going to be a question that doesn't just apply to the Federal Reserve, but central banks around the world, Tom.
Kriti Gupta, thanks so much. OPEC with some headlines. We'll get those out to you. 111.30 on Brent crude, up $1.16 right now. And John, there really is no other story right now. We go from the Fed yesterday, the Bank of England today. What will be the surprise in jobs tomorrow?
Let's get to Guy Johnson in London. Guy, you and I have both shared that room with the Bank of England governor many times over the last decade or so. With Governor King when he had to look through higher inflation, with Governor Carney when people accused him of having a housing bubble and all kinds. In Brexit, Guy, time after time, there were tough news conferences. Guy, I can't think of actually a tougher news conference than this one for this governor in his tenure.
Absolutely. John, this is clearly an incredibly divided MPC. Probably the most divided MPC I think I've ever seen. It is ironic in some ways that the bank is celebrating today 25 years of independence. This is a really difficult situation that the bank finds itself with here. My initial reaction was it was a hawkish hike. They're clearly wrong. Look at what is happening in the market right now. I don't know where the bank is going to go next. The market is still pricing, John, 118 basis points of hikes between now and year end. That could be way off the mark. Is the Bank of England done? Is the Bank of England going to deliver further hikes? Bailey's talking about upside risk to inflation in the near term. RPI is going to be well into the double digits here. He's talking about the inflation pain that the UK population is going to feel. But he's also talking about the idea that when inflation comes down, it's going to fall precipitously. And the idea here seems to be, John, that basically the Bank of England is going to use inflation to crush demand in the economy and bring inflation back down to target and potentially below target. The risk around that is massive. If you end up unanchoring inflation expectations, the risk, Tom, of a wage price spiral is definitely there, lurking in the wings.
Guy Johnson, let me go to you, but John, jump in here as you see fit. John mentioned this earlier, Guy. I think we have a real understanding on surveillance of the relationship of Mr. Powell with Secretary Yellen with the administration in America. What is the relationship of the Bank of England to Mr. Sunak, Chancellor of the Exchequer?
Tom, I'm going to dodge this. And the reason I'm going to dodge this is because there are polls open here in the UK today. And as a result of which, talk of fiscal policy is going to stray us into an area where I think regulators are going to have a little bit of an issue with us.
Wow.
So Let's park that for just a moment.
Okay,
but
fair.
clearly that is an issue that other central banks are going to be thinking about. You look at what is happening over on the other side of the English Channel. You think about what the ECB is doing right now, and they find themselves in a very similar position. Fiscal is going to have to do the heavy lifting for the ECB,
Right.
Tom. Nod, nod, wink, wink. But maybe we're going to see that, maybe
Okay,
we're not.
I don't, John,
but certainly we're watching carefully.
I mean, John, is this like if Guy screws this up with the election today, does he go to the Tower of London or is he forced to watch Tottenham?
I think those days are gone, Tom.
Oh,
Those
okay.
days are gone, but I'll try and keep Guy out of trouble as well.
Yeah.
Guy, it's not clear to me how much distance there is between the dissenters today. There was a set of individuals, the 3 that wanted a 50 basis point hike today, and the 2 that wanted it to be over, to signal to the market we're done now, through the next couple of meetings. Guy, we're getting an understanding of that from Governor Bailey in this news conference, just how much distance there is between this group of people on the one side and another group on the other.
We don't know who those 2 were, John, which I think is significant. And you've made the point to me that maybe actually it could be it could be some of those that are voting for a 50 basis point hike, i.e. you front load it, and as a result of which you're done. But I come back to this idea that the market is still pricing 118 basis points. The market is still looking for significant hikes from here. If we are going to change that, that is going to be a huge volte-face for the market and the Bank of England. And once again, we are flip-flopping. We don't know what the reaction function of the Bank of England is. We don't know what guidance actually really looks like. It's interesting they haven't made a decision on when they're going to start QT for gilts. I don't know, John, what that distance is. This is an unbelievably murky picture surrounding the MPC right now. This is an unbelievably divided MPC. We seek further clarity. Who is it that has decided that we don't need any more from here? Are they the same people, as you suggest? Could be a possibility. I simply don't know the answer to that question. But we find ourselves, I think, with a lack of clarity that the market is struggling to price here. And as a result of which, I think the instinct is to look at the economic numbers that the bank is projecting and say, actually, if those are the numbers, the bank is going to find it really hard to hike into a recession.
Guy, awesome to catch up with you, buddy, as always, and looking forward to the show a little bit later. Guy Johnson picking things up later on Bloomberg TV, taking you into the close, and on Bloomberg Radio a little bit later as well. The issue, I think, for a lot of people today is just how transparent the Bank of England is being here. The dynamic is tough. Upside risk to inflation, downside risk to growth. We've talked about that repeatedly through this morning. But ultimately, at the same time, you've got a governor that can't really offer you a consensus because there isn't one. How do you reflect the consensus when there isn't a consensus at all?
Is there a consensus in Washington?
Right now on what, Tom? At the Fed?
At the Fed, I'm not sure there is.
I think there's division of the Federal Reserve further down the road. How far they want to take this beyond 2%, beyond 2.5%. There's division right now at the Bank of England. The uncertain outlook led to a range of views on the MPC. That was Governor Bailey moments ago. And that outlook right now for this British economy and for the economy around the world is incredibly uncertain. Cable, 123.82. You've got a move on pound sterling of 2 full percentage points against the US dollar. Futures right now, down 0.5% on the S&P. From New York, this is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There are areas of the equity market, the global equity market, that have priced in what we think is the worst case scenario.
At least some of this inflation is temporary and will start to ease.
I think the job of the Fed right now is to show that they can bring inflation down.
We're very sensitive to a little bit of loosening of this sort of Fed vice that we've been caught in.
This is not a Fed that wants to do shock and awe. This is a Fed that wants to control the marketplace, let the medicine take hold.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jobs day tomorrow, the Fed day yesterday, this morning, history at the Bank of England, and it reps into all of global Wall Street. John, you've lived it. Governor Bailey in a very small chair speaking to the British people.
And looking to engineer a soft landing on a very, very small landing strip as well, Tom. And that's a tough task for this governor right now. Forecasting at the Bank of England, double-digit inflation by year-end and potentially a contraction in the economy next year. And a Bank of England rate-setting committee that just does not know what to do this year.
Within that, John, is the dissent. And, of course, Governor Bailey here doesn't agree with calls for a far bigger move. Okay, fine. Is that dissent normal, John?
The dissent we're seeing this morning is not normal. No. You've got two policy committee members who are essentially saying they want to be done for the next couple of meetings now.
Exactly.
And see what happens. You've got three that wanted a bigger move today. What's unclear to me is how much distance there is actually between the three that wanted a 50 basis point rate hike today, we got 25, and the two that wanted to stop. I wonder how many of those three, if they'd got that 50 basis point rate hike, would also have been on the same page as those who want to stop now and wait and see. Either way, you have a classic central banking dilemma, don't you? When you have upside risk to inflation and downside risk to growth, it's terribly difficult to know what to do. And that's the position this governor is in today.
And what's interesting, Andrew Sheets will join us here in a moment, folks. You get lucky sometimes, and to have Andrew Sheets with us will be great. Lisa Abramowitz, this alludes to something you've talked about, which is this idea of optionality forward. We heard it from Chairman Powell yesterday, making it up as we go, to neutral versus forget about one and done, as John just mentions, Lisa. Maybe it's two and done at the BOE.
Basically, are they going to raise less than the market is currently pricing in because of this dilemma that they're facing? A question underscoring a lot of what Governor Bailey is talking about is, are wage increases good or bad? Basically, he said one of his hesitations from raising rates too much right now is because he doesn't want to curtail real wages, which are falling at such a hard pace. Even though there is tightness in the labor market, is that a bad thing or actually a good thing in order to soften the blow from some of these higher prices? And I think that's the dilemma right now as they try to take some of the momentum out of the economy, but not so much that it just exacerbates the pain.
John, to start the data check, intraday sterling 123.81.
Just to see it with a 123 handle is quite something, Tom. A breakdown this morning, 123.98 and negative 1.9%. The story elsewhere in the equity market, futures okay, down 0.6%. We had almost a 3% move yesterday, so this just a little bit of a correction on the S&P. On the Nasdaq 100, negative 0.8%. The dynamic the Bank of England is confronting, is that the dilemma the ECB has to confront as well? Euro dollar back to 105.55. That currency pair, Tom, negative 0.6%.
Joining us now, the right person at the right time. Andrew Sheets joins us with his Brown Mathematics Chief Cross-Asset Strategist at Morgan Stanley. Do the math, Andrew Sheets. At one point, it's about policy along the time continuum. How is Bailey's time continuum different from Powell and, as John Farrell mentions, Christine Lagarde's?
Well, great. It's really nice to be here with you. So I think you put it rightly. These are three central banks, all with slightly different challenges. I think with the U.S., you have a clearly strong economy, and I think that's more of a classic challenge of central bank policy that's trying to slow a strong economy where employment's very strong, and where a lot of that inflation is coming through the core parts of the inflationary channel. Now, for the ECB, it's different. The inflation is a lot less in the core elements of CPI. The inflation is a lot more being driven by energy and food prices. And the risks to the economy are this very binary geopolitical risk to the energy markets, more so than probably kind of traditional slowing of fiscal policy or other factors. So, I think when it comes to the ECB, there's a little bit more flexibility. You also have the ECB, which is in a negative rate scenario, unlike Bank of England and the Fed. Getting out of negative rates is something we think there could be broader buy-in to. And then I think, as you alluded to, I think the Bank of England is in the toughest position of those three banks. It has a weak economy. UK growth is some of the weakest in the G7. It has a large current account deficit, unlike the Eurozone. And you have very high inflation, higher inflation than you have in the Eurozone and comparable to the US. So I think this is a real challenge. I think we're seeing it come through the currency markets. And I think markets could continue to apply a higher risk premium there, given those higher challenges and higher uncertainty.
Andrew, the Bank of England today is effectively communicating that a soft landing is the stuff of fantasy. Do you think that is true of the United States too?
Well, not necessarily. I mean, I do think that the U.S. does have some shocks to its inflationary backdrop that are unique, are being driven by geopolitical risks abroad, are being driven by supply chain concerns. And so I don't think it's unrealistic to think that the inflation numbers in the U.S. 3-6 months from now are coming down, which would mean that the wage picture starts to show real wage growth again. And that all starts to look a little bit better. You've also already priced in a 1994 style hiking cycle in the US. So I think it's fair to say that soft landings are difficult. There are, they are less likely than more likely if we look back through a lot of hiking cycles, but I don't think it's impossible. And I do think the important element here that we probably don't talk enough about is that the Fed is only part of this story. The other half of it is what fiscal policy is going to do, how fast or will it contract, and how do the U.S. midterm elections affect that? And again, we're some ways away from knowing how that will affect policy in 2023.
Andrew, I definitely want to double down on that whole midterm election question, but this is not the moment as we talk about the potential for stagflation. How long can the U.S. remain the only one, right? The only major economy that's avoiding a stagflation-like kind of environment if you have the Bank of England addressing something very similar to that, as well as the ECB?
Well, it does put the U.S. in a difficult place because I think, Lisa, as you correctly mentioned, the U.S. being this strongest house in the neighborhood is leading to a lot of dollar strength, which is only tightening U.S. financial conditions further. So it's not just that the U.S. economy is facing a more hawkish Fed, it's also facing a much stronger dollar, and those Fed interest rate increases and dollar strength are both doubling up on slowing the economy down. So that is a challenge that the Fed's going to face. That's one of the reasons why we do not think that the market is underpricing the Fed. We think, the market currently pricing the terminal rate around 3 1/8, 3 1/4 is about right. And part of that is, well, the dollar is also up a lot, which will also slow the economy. But it is going to be important that growth elsewhere picks up. It is going to be important, especially in Europe, where our base case is for actually quite reasonable growth this year. But you still have this enormous uncertainty around the energy security picture, which makes it hard to have as much confidence in that forecast as we would like.
So, Andrew, how does this equate into some sort of strategy? Are you buying longer-term treasuries on this conviction that you are going to get a slowdown? And are you doubling down, frankly, on U.S. assets?
Well, so we do think that U.S. 10-year rates are pretty fair at current levels. We would no longer be underweight. We closed our underweight position in treasuries earlier this month. But we think, around 2.93% on the 10-year, when you've already priced in a 94 style hiking cycle, and when we think growth is going to slow in the U.S. with all this tightening of financial conditions, as inflation also moderates, that seems pretty reasonable. And so I do think a lot of investors have been underweight duration correctly, but we think this is now a time to start moderating that position. I think this is also an environment that is very well suited for oil and for energy to outperform within the commodities complex. We think the oil curve remains very backwardated, which means investors are paid very well to hold oil. And if we think about inflationary risks, it's very hard for us to see those happening in any way that does not involve higher oil prices over the medium term. So that's another asset class that we think outperforms on a broad cross-asset basis.
Andrew, wonderful to catch up with you, sir. As always, Andrew Sheets there of Morgan Stanley, following that call over the last week, essentially, Lisa, saying that the long end has peaked for now.
Yeah, basically saying that what we're looking at is what's going to be a slowdown because of what's going on. And frankly, this fascinating confluence of events where you've got a strengthening dollar that's tightening policy as much as some of the rate hikes. I don't think we've made enough about that at a time when the dollar strength just is incredibly resilient.
Seeing some dollar strength right now, aren't we, in a big way against one particular currency?
Yeah.
Tom Sterling, 124.10, just this move of 1.75% on the day.
11.9% rounded up, 12% of the acclaimed DXY index, a lesser percentage of the Bloomberg dollar index. And John, looking at DXY at 103, I mean, there's some other factors going on here, including yen, which hasn't moved. But you just, as Andrew Sheets talked about, you wonder where currency comes in as a release valve for these oddities in the system of economic slowdown, and yet we've got to raise rates. I mean, I've never seen it.
I know you're super focused on crude too, Tom. Brent at 111, just short of 112, WTI at 109.
John, a backstory. This is a huge unspoken deal to see diesel do what it's doing in America and, frankly, in war-torn Europe. And a gallon of gas, I'm sorry, it's creeping up.
Acknowledging these problems over at the Bank of England, Lisa, the governor essentially communicating to the audience, to the people of the UK, that we face a problem. And he understands the pain they're going through. And part of that is the energy price story.
How do you then adjust monetary policy to deal with that? Because that's not exactly something they can influence. I mean, they can't pump more oil at the Bank of England.
It's tough. It is really, really difficult right now to set policy in a world like this one. Paul Sankey's going to join us shortly. Great guest on the commodity market, founder and lead analyst at Sankey Research, coming up next. From New York, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. OPEC and its allies have stayed the course. The alliance has agreed to raise our oil output by the expected 432,000 barrels a day for June. Still, most countries in OPEC Plus are struggling to keep pace with their rising output allowances. And Elon Musk has won the backing of some of the world's biggest investors for his proposed $44 billion takeover of Twitter. According to a filing, Musk secured about $7.1 billion of new financing commitments. The investors include Crypto exchange Binance, Brookfield, Fidelity, and Qatar Holding, plus billionaires Larry Ellison's trust committed $1 billion. Ellison has a stake in Musk's Tesla and a seat on its board. And the Bank of England has raised interest rates to their highest level since the financial crisis. Plus, it warned the economy is on course to shrink under pressure from double-digit inflation. The quarter-point rate increase to 1% was backed by 6 of bank's 9 policymakers. The other 3 wanted a half-point hike. And Ukraine's President Volodymyr Zelensky is trying to crowdfund the war with Russia. Zelensky's announced that Ukraine has launched United24, an online platform to raise money from anywhere in the world. He said that together the war with Russia can be stopped and what Russia has destroyed can be rebuilt. And those shares of Shopify are falling. The Canadian e-commerce company posted quarterly revenue and profit that missed estimates. Shopify also announced a $2.1 billion deal for startup Deliver. It's the company's largest acquisition ever. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This week, April jobs are in focus.
It's a very, very good labor market for workers. The demand for labor, obviously, much stronger than the supply.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
As long as the numbers hold up, the Fed is going to feel encouraged.
Then 75 in June is certainly not out of the question.
To me, the question is, are we fully employed?
The elephant is the war in Ukraine.
The April Jobs Report, Friday on Bloomberg Television and Radio.
Due to the invasion and to COVID developments, particularly in China. These developments have exacerbated greatly the challenges already facing the UK and many other economies from the series of adverse supply shocks that we continue to face. Monetary policy, therefore, must navigate a narrow path between the increased risks from elevated inflation and a tight labour market on one hand, and the further hit to activity from the reduction in real incomes on the other.
That's the tough spot this Bank of England governor is in right now. That was Andrew Bailey just moments ago saying that no one advocated for a 75 basis point increase. Let's be clear, that's not having quite the same effect that Chairman Powell had saying the same thing just yesterday. Equity futures this morning, and good morning to you. Negative 0.5% on the S&P, a monster move high yesterday on the S&P 500. The biggest one-day rally going back to 2020, up by almost 3%. Yields coming in just a little bit, down not even a basis point now to 293.27. The euro is a whole lot weaker, the dollar a whole lot stronger after the move yesterday, 105.66 with negative 0.5%. But the big move is pound sterling, 123.92. We are down by 1.9%. That is a weaker pound sterling, TK, in a big, big way.
And I would respectfully suggest, folks, to get every second of value we can here, that Benjamin Broadbent, Deputy Governor of the Bank of England, ex-Goldman Sachs, truly one of the giant lights of United Kingdom economics, and Governor Bailey, they would like to listen to Paul Sankey. He is founder and lead analyst at Sankey Research, with an absolutely blistering note for a 2-hour conversation. Paul, I want to go to the nitty-gritty of your expertise, which is you link Henry Hub and LNG into a net gas explosion in price and profit. Discuss that.
Well, supply, U.S. production is not reacting to high prices, so a lot of our normal elasticities are simply not there. And the other key one is that coal prices are very high and coal inventories are very low. So the U.S. price, as you know, as you mentioned, has gone to $8.50 per MMBTU, which is, you know, a 15-year high. And I've got clients that think it's going to 20. So the reason, obviously, is that Europe is cutting off Russian gas. And as a result, they have to import as much LNG as they can. They were dependent on the spot market, so they don't have long-term contracts. And as a result, effectively, they're having to buy LNG from a buyer, from someone who's already got the contract from Asia.
And to put
so it's a mess.
And to put it in scale, folks, net gas, we frame at 2, 3. It's now 8. And Mr. Sankey just said we should enjoy 20. Paul Sankey, let's look at the United Kingdom and the United States gallon of gas. And I understand there's taxes and John drives a little car over there. I get it. But it's $4.58, up 26%, to United Kingdom $5.79. You say the profits are out there for big oil like you've never seen in 30 years. It goes back to Jurgen and the prize, the whole thing. What's a gallon of gas going to cost in 3 or 5 years?
Well, I think we're going to hold 110 to 150. We've wobbled below 110, as you know, on Brent, but now we're back in the range that I anticipated after Russia. And the call was that it would be a quagmire in Ukraine, and that would, over time, the longer that went on, the more Russian oil and gas we would lose. Now we're focused on May the 9th for the key date in Russia where they celebrate the victory over the Nazis. And we're wondering what's going to happen, but that could be a key catalyst date, whether or not Putin declares victory, whether or not he goes to all out, bombing. I don't know what he's going to do, but we're watching that date carefully. But what we do know is that Russian oil and gas has now effectively gone from the market as far as the EU is concerned. And that's a very, very big deal for markets, which were already tight, as you know, before this all kicked off.
Paul, a lot of this goes to how much can people keep betting on oil companies at a time when there's a lot of complaints, especially on the regulatory and political side, about how much gas prices are going up, how much oil prices are going up. Well, at the same time, there is this uncertain backdrop on the macroeconomic picture. Shell just reported a record profit. We've seen this time and time again. How much more upside is there in these companies given the 50% rally year to date, given the fact that there is all of this regulatory scrutiny?
That's the number one concern of the clients. So that, the buy side, obviously, is my clients. The investors in oils are worried that the government won't tolerate, the US government, for example, won't tolerate $10 or $20 Henry Hub gas because of the impact it'll have on US consumers. But, the government's very weak and they don't have an energy policy. And they have a couple of key senators, Joe Manchin, obviously, who oppose any kind of interference in markets. And it's complicated to interfere in the gas market. It's a free market. These guys are selling gas directly by contract through processing hubs like Cheniere. To shut that down as a government would be difficult without legislation, and legislation we think is very difficult. So I think, much like the OPEC meeting that you just asked me about before we came on, they're kind of powerless. There's not much they can do, and we're just at the mercy of the market. And that's why it's such a crazy environment for the oils, because, the money they're going to make is going to be enormous, and it will infuriate people, but what are you going to do about it?
It's been a nuts environment, that's for sure. Paul, thank you, as always, buddy. Paul Sankey there of Sankey Research. We're crude at Brent, 111.82 at 1.5%, TK WTI at 1.3% to 109.20.
What's great here, John, is Mr. Sankey just mentioned this idea of a feeling of powerlessness. Is the Fed trying to be an institution where we're in control, and the Bank of England is maybe, John, being a little more honest and saying we're really not sure the power that we have? It's sort of navel-gazing, but I really wonder the difference in language is
questioning
stunning.
The honesty of the Federal Reserve is problematic for me to do, Tom, although I'm happy to do so if you wish. They're being transparent at the Bank of England about the future in a way that the Federal Reserve is not.
They're engaging in debate, folks, which is true of all of economics. And the heritage is there, John, let's be honest, about a much more fractious and visible discussion at the Bank of England. But and to one of our guests who mentioned it, I'm sorry, I can't remember, John, what does this mean for ECB? What lesson do they take from the tumult today?
This is the problem. The challenge for the ECB, they're at negative 50 basis points on the depot rate. So they're already at a much lower interest rate setting than the Federal Reserve and the Bank of England was. June 9th is the policy decision at the ECB, and I would suggest that this is a difficult one. They've got to wind down QE, we know that. They've got to talk about engineering the first rate hike. We know that. But this was the question I had as soon as the Bank of England hiked back in December. It was, how far are you going to take this? How far can you take this? And here we are with a challenge from the growth outlook.
John Sterling breaking down now. New weakness this morning, 123.68.
It's ugly, TK. It is ugly. Tomorrow we have a jobs report in the United States of America, and we will catch up with the chief economist at ADP next. From New York, this is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York for our audience worldwide on TV and radio, this is Bloomberg Surveillance. Your equity market shaping up as follows. About an hour out from the opening bell, we're negative 0.6% on the S&P, and the Nasdaq down 0.75%. Bit of economic data coming out in just a moment. Let's cross over to Mike McKee down in D.C. Morning, Mike.
Good morning, John. Well, it's not directly related to tomorrow's jobs report, but the number of people filing for first-time unemployment benefits ticks up a significant amount given where we are, up to 200,000 from 185,000 the prior week. So a 15,000 gain now. That's statistically insignificant, basically, but it does tell you that there are still people who are, for one reason or another, looking for unemployment insurance. But as I said, this was not the reference week for jobs. So tomorrow's numbers aren't going to be affected by this. The other number that is out today that is bad news is non-farm productivity, down 7.5% in the first quarter. That is from a 6.3% gain in the fourth quarter. And it just shows you the swing in GDP made a big difference in productivity. Unit labor costs rise 11.6% after rising 1% in the fourth quarter. And let me just check here. That is the most since 2020, which of course is going to be because of the pandemic. But I'll have to see what the lowest, rather the highest that is in terms of unit labor costs before that was. You probably have to go back
2014.
to 2014. So at this point, it looks like companies are paying up and getting less for it. At least they were in the first quarter.
Right. Mike, let's get a clinic on that while you were yammering away there. And it's really hard for Mike McKee to do this, folks, with the headlines coming out. I went to unit labor costs in a fancy chart here. And basically, the longer-term moving average of unit labor costs, Michael McKee, get us back to the early 1990s. What does that signal about wage inflation that we may see tomorrow?
Well, the numbers suggest that we probably will see continued wage inflation. Also, the fact that the unemployment rate is forecast to tick down to 3.5%, and we may not see a lot of gain in the labor force. So we are expecting wages to go up. Jay Powell said the labor market is extremely tight. But you want to go back to the 1990s, what happened then was Alan Greenspan raised interest rates by 300 basis points, and we did not have a recession. Instead, we got a very long, very strong expansion. So I guess there's two paths that we can follow here, from here.
Payrolls on Friday, tomorrow, Mike, onto CPI next week. Just looking at one of the estimates from Morgan Stanley, 8.1%, down from 8.5. Then you get into core and the month-over-month figures too. Mike, away from payrolls into CPI next week, what's the focus for you?
Well, it's going to be the core rate because we know that we're going to see energy and food price pressures continue, especially with what's going on with Ukraine and Russia. So is the core rate slowing down? We saw that in the PCE numbers last week, the Fed's favorite indicator of inflation. And if the core rate is moderating, that would give the Fed some hope that their interest rate increases would have an effect. But we also want to look at what housing is doing, because that's going to take a long time to come down, and it has added a lot to price pressures in CPI.
Mike, awesome work yesterday, buddy, by the way. Great to see you back in the room, in the news conference, getting back to German pound. Isn't that good to see, Tom? Just to get them back together again. It's like a reunion for economists down.
Well, we're seeing it in all sorts of things, and it does speak to the optimism, and James Bullard talking about this, John. I mean, let's review that quickly here before Neela Richardson. I mean, the gentleman from St. Louis has an optimism of a resilient American economy.
The gentleman from St. Louis is scheduled to speak tomorrow for the people that are interested.
I did not know that.
In the evening, alongside Governor Waller, too. A couple of Fed speakers tomorrow that are going to be quite interesting. Brammer, just to go through the data, 200K, upside surprise, historically still very low for initial jobless claims. I know unit labor costs caught your eye as well.
This, to me, is really concerning for the Fed at a time when you do have this tightness in a labor market that's not necessarily being reflected in the numbers the way perhaps they have traditionally. The idea that it's on the wrong way up, the fact that we're getting an acceleration in wages rather than some sort of deceleration. Is this a good thing or a bad thing? As we saw from the Bank of England, you need wage increases so that people can keep up with the price of inflation. The problem is that could exacerbate how far inflation can go.
With ADP, their chief economist, wonderfully attuned to the dynamics of the American economy, Neela Richardson, joins us right now. Neela, I'm looking at core CPI that John just mentioned, and I guess it's a pause that McKee just mentioned. We migrate from 6.5 to 6.1% on the survey on core inflation. 114% of our audience on radio and TV thinks people like McKee, Farrell, Keene, and the rest are nuts, saying that's a good trend. How much does that trend have to move down to where we can begin to relax?
Hi, Tom. Thanks for starting off with an easy question. I think we're going to stay on the edge of our seats until we see that core inflation move down below 3%. Yeah. I think that we can't take it as a foregone conclusion that it moves down in a straight line either. Many on your show have said that the Fed can only do so much, that this is a supply side issue as much of it as a demand issue. And so we might see inflation bounce around even in the core rate. And so comfort is, I think, of below 3%.
Neela, do you think that people interpreted yesterday's press conference correctly?
No, I don't. I think that it was way too easy for the Fed, and I know that's part of their job. Their job is to make it look easy, but it's not about what the markets do the day after the press conference. It's what the inflation does months from now, and we haven't seen it yet. And the numbers that Mike just read are concerning. Productivity went down, wages went up. And so that's not the place where the Fed wants to be. They want, if wages are going up, it's because the economy is getting more productive, not because we have this super tight, unhealthy supply shortage. And I think that is the concern. Wages may not boost inflation, but wage growth, keep it around a lot longer than anyone's expecting right now.
Another thing that really a lot of people picked up on that Jay Powell said yesterday was that he really sees the core rate, the target rate, to still be around 2 to 3% in terms of how far they will raise rates. Do you think that that's something we can take at face value, or do you think that perhaps there is more willingness than perhaps was reflected to go beyond that into a tightening that perhaps was what people were pricing in earlier this week, but not now?
Well, I think that for now, in terms of the fundamentals, which are strong, and where the Fed is guiding towards, I think that's appropriate. I'm always struck by this comparison with 1994, going from 6 to 11 versus where we are not now, going from rock bottom 0 to 3. We're still in the school zone in terms of rate hikes. We are not on the open highway. So I think what the Fed is trying to say is that they can maneuver a soft landing, given that we're starting from such a very low point on the federal funds rate.
You were out at Indiana University, which I believe is the stomping ground of one James Bullard. John Farrell says Mr. Bullard will speak tomorrow. And Indiana, folks, is a really acclaimed, interesting mathematics and economics combine. Neela, there's a different view out in Indiana. It's an optimism that America can heal and move on away from the elites on the East Coast. Is that still in place? Can we technologically move on and move forward like that Indiana optimism?
I'll have to note, Tom, that Governor Waller is also an IU affiliate too. So we have a good representation on in the Federal Reserve System right now. You know, I think that the optimism around innovation and productivity is warranted. That's what makes the wage gains good for the economy. That's what leads to profitability. And we've seen a big uptick in innovation just to get through the pandemic. A lot of things that were expected well into the future in terms of e-commerce and AI, automation, have been pulled forward. So the question is, can the economy build on that momentum, on those gains, to keep that productivity moving forward?
John, I love this that we have Neela on, and I'm sorry, John, there's just not enough Midwest, freshwater representation in the economic discussion. You get guys like Jerome Powell, who are a beast of finance on the East Coast.
Neela, we have to run. Thank you. Then we'll do the geography class
Thanks so much.
A little bit later. Neela Richardson there of ADP. Thank you very much. Tom, to Neela's point about this data that came out just a moment ago, productivity down, unit labor costs up. Walk me through that, Tom. Just walk everyone through that, why that is so complex and difficult.
Okay, and on radio, this is really difficult because I got the proverbial radio hands up. John, there's one ratio. There's a lot of that. Sterling, dollar, sterling, one fraction. Then there's other relationships that are 2 fraction. There's even equity relationships that are 5 fractions, but productivity as a general statement is the moving parts of 3 different relationships, 3 different fractions. And what Neela's saying is the dynamics of those 3 moments right now are unit labor costs are going the wrong way, and productivity is going the wrong way, the efficiency of the American economy. And that's just not the right kind of productivity, the right kind of dynamics within that interesting relationship.
Lisa, it's problematic.
I'm looking right now at unit costs just on a historical perspective. The last time, aside from the pandemic disruptions, that we saw unit costs of labor rising at this kind of pace, twice in 2004, and then I can't find any more going back decades, right? So this is basically giving you a sense of how historic the wage gains have been, how historic the labor costs have been at a time when we're not seeing more for it. This is not what they want to see.
And John, this goes back to Professor Romer yesterday, the laureate, and this phrase that's always tough to explain, total factor productivity. And as Ms. Richardson just stated, the pandemic sped it all up.
Looking ahead to payrolls, your estimate 380K. In the month of March, the number was 431,000. Coming up, Lisa Hornby is going to be joining us on the market, fixed income, and everything that happened with the Fed yesterday. Joining us from Schroders. Also, Jonathan Golub of Credit Suisse on his recent downgrade on the S&P, and Chris Harvey of Wells Fargo around the opening bell. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Billionaire Larry Ellison is just one of the well-known investors agreeing to back Elon Musk's acquisition of Twitter, according to a filing. Crypto exchange Binance, Brookfield, Fidelity and Qatar Holdings will also have given new financing commitments totaling $7.1 billion. Plus, Saudi Prince Al-Walid bin Talal has agreed to roll over his current investment in Twitter. OPEC and its allies once again agreed on a small monthly increase in production. It comes at a time when global markets are likely to get tighter because of the EU's proposed ban on Russian oil. OPEC Plus ratified a 432,000 barrel a day increase. Analysts doubt the alliance will be able to deliver even that much. And the coronavirus death toll probably climbed to almost 15 million people in its first 2 years. In other words, about 1 out of every 500 people worldwide. That's according to the World Health Organization. The new estimate is more than twice the figures from individual governments' reports. And Warren Buffett is boosting his bet on Occidental Petroleum. Buffett's Berkshire Hathaway has bought up almost 6 million more shares of Occidental. Berkshire had previously built up a stake of more than 14% of the company. Occidental was the best performing stock on the S&P 500 during the first quarter. And BMW posted first quarter profits that beat estimates. The German automaker and its rivals have been hampered by the semiconductor shortage and other supply chain issues, so they have shifted production to higher margin models. BMW delivered 6% fewer cars, but revenue rose 17% over the previous year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft.
that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
UK GDP growth is expected to slow sharply over the first half of the forecast period. That predominantly reflects the significant adverse impact of the sharp rises in global energy and tradable goods prices on most UK households' real incomes.
The Governor of the Bank of England, Andrew Bailey, with a very difficult task ahead for the unique economy that is the United Kingdom. It was not that he shocked the world today of finance, it is the descent. It is Bank of England, and Lisa Bramwich, just to frame this out, it was a descent not seen yesterday at the Fed.
Yeah, honestly, this has been a very difficult path for the Bank of England, and they have a very different trajectory than over at the Federal Reserve because they cannot even count on saying there is going to be growth next year, seeing actually a contraction, even amid hiking rates.
And it is appropriate to end this hour, and we'll drive forward this story through the day on radio and television with Mark Chandler. His book, Political Economy of Tomorrow, looked at the astrology of the foreign exchange system. He's chief market strategist at Bannockburn. Mark, you're a great student of this. I want to go back to 1992. I believe John Major and essentially the modern collapse of the British financial system. Yes, there was a few other moments along the way, including Mervyn King. Compare and contrast what is coming for Governor Bailey and what John Major dealt with in 1992 with sterling collapse.
Yeah, so now remember in 1992, the UK was part of the exchange rate mechanism that limited how much the sterling could move. It had trouble keeping into that, maintaining that band. And now the UK has gotten its freedom. It's not limited by that band, and sterling has collapsed. You know, yesterday, Chairman Powell talked, sort of like channeled Paul Volcker, but I think it's really Bailey who's doing it. Despite what Lisa was saying, the UK's the Bank of England's forecasting contraction in GDP next year, and still going to be stagnant in 2024. They're hiking rates, and not only hiking rates, but they also announced that starting September they will begin selling off its corporate bond holdings.
Mark, what will be the lessons here? And this, I think, folks of the great Jens Nordvig and Mark Chandler together on this. Mark Chandler, how does the ECB, in a more conservative bloc at the ECB, is represented by the Bundesbank, how do they respond to what we've seen this morning?
I don't think that what happens in the Bank of England makes the ECB change their dynamics whatsoever. I do think the hawks have been pressing for a July rate hike. And the market, the swaps market, has it priced in about a 25 basis point hike in July. But I think that this is scary in the sense that we saw that happen today with the factory orders in Germany, weaker than expected industrial output in France. Europe as a whole, it's not just the UK, but Europe as a whole looks to me like it's headed for a recession.
Is that being priced into the euro right now, Mark?
Well, I think partly, but I think that really what's priced into the euro is how aggressive the Fed is. I know a lot of people are critical of the Fed that they're behind the curve, but I think that they're playing catch up. And it's not just that the Fed is behind the curve, something wrong with the Federal Reserve. But look what happened. Sweden, who said they weren't going to hike rates until 2024, hiked rates. And it's the same thing that we've seen from other central banks like the Reserve Bank of Australia, hiking rates even. So I think that all the major central banks are behind the curve. But partly because I want to say in their defense that the pandemic and then the Russian invasion of Ukraine, and then the slowdown, the COVID sort of induced slowdown in China, is just more than anybody would have expected or were able, nothing in our experience let us prepare for this.
A lot of people are talking about the potential for recession in Europe. The Bank of England seeing a very high likelihood of recession in England and the United Kingdom in the face of these dynamics. In the U.S., there seems to be a consensus that that is not the near-term forecast, that there is so much of a momentum here underpinning the strength. Do you think that that's overstated, or do you think that people can bet on that, leading to even more dollar strength?
Well, I do think that we'll get some more dollar strength there. And I think that tomorrow we're going to get the jobs report in the U.S., and I see the estimates falling a little bit, but we're still talking about 380,000 increasing in jobs. It's hard for me to see a recession with that. So I am very sensitive to that. We are going to have a slowdown. I sort of just see it taking place later this year and into next year, not so much an immediate, in the next quarter or two. We did have that sharp contraction in Q1 GDP, but that was really a statistical fluke, right? Because of trade and inventory. What the economists call final sales to domestic purchasers was actually a relatively robust number.
Mark, I want to go back to how we were all weaned on this because all of us began foreign exchange and banking by watching Julie Andrews and Mary Poppins. I mean, let's be honest, Dick Van Dyke stole the show. And Mark Chandler, there's a view of the Bank of England. I mean, Farrell grew up with this view of the Fidelity and Fiduciary Bank, which was the bank in the movie Mary Poppins. We have moved on from that, from Mark, a new central bank that is supposed to have a new social construct. Is that social construct getting in the way of making tough decisions?
I don't know. I mean, look what they just did. They hiked rates. 6 members, they all voted in favor of, 6 voted in favor of the rate hike. 3 of them wanted a 50 basis point rate hike, knowing full well that the cost of living squeeze is going to be crushing the consumer and businesses in the UK. I don't know. I don't see this as some kind of give back to the social consciousness. Where I sort of see that happening is really in Mexico, where yesterday President AMLO announced a pact with businesses to limit the price increases of like 24 common products.
Mark, we got to leave it there on short notice. Mark Chandler today with Bannockburn. I just love the tapestry, Lisa, that Mr. Chandler puts to the history and the social aspects of all this financial blather that we do. You know what, Lisa, what I know is all of this is shown first in what you're expert at, which is the fixed income market. How do you presume debt on price and on yield adjust to what's been wrought in the last 48 hours?
Another way to put this is, how do you price in stagflation? How do you price in the risk of raising rates at a time of slowing growth? And this is frankly a situation that some people, Chris Ailman actually of CalSTRS, the second biggest U.S. public pension, came out yesterday and said there is no good trade when it comes to stagflation. Everything fails. And that's what we saw last month. Going forward, most people are saying in the U.S. we are going to avoid that. People are saying it is looking a lot less likely in this moment.
Lisa, can we have a moment of silence right now?
Please, let's have lots of moment.
On radio, folks, we're going to do this right now. Let's be quiet. A moment of silence for Lawrence Summers as we have now. You know, he's a piñata, but Claudia Sam went after him the other day and many others. Larry Summers is a piñata, but when you see the public policy action today that we saw from Professor Mann, Saunders, Ben Broadbent, who's just outstanding, and Bailey. I'm sorry, policy and economics meet up with a crushing force every once in a while as Summers lived.
Although we don't really have an understanding of what the dissenters were going for. Were they trying to get ahead of, and this is what John was harping on, basically saying, were they trying to front load as many as possible and then being done with it and to sort of create a shock there? Or were they actually saying they needed to be more aggressive?
I think you're absolutely right. And, the joke is it's not one and done, it's two and done. And I don't know what the calendar is here, Lisa, but I do think it's a complete difference from Powell and the reaction function out to neutrality versus the let's go that we saw this morning. Thank you to Guy Johnson helping in London this morning as well. Please stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We are taking away some of yesterday's rally from New York City this morning. Good morning, good morning. Your NASDAQ down about 1 full percentage point after rallying big time in yesterday's session. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Powell burying 75 basis points.
75 basis points.
He took it off the table. Removing the 75 basis point. It's not necessarily dovish.
It's just a repricing of the degree of inflation panic.
75 basis points. That reeks of panic.
Therefore, you saw this massive relief rally.
It was quite a surprise.
But, I mean, don't forget.
Eventually, the Fed might have to hike more.
Ultimately, they do need to slow the economy in order to deal with those inflation pressures.
They need to move in a way that does not cause a recession.
What it's doing is delaying the decision.
You can't have the cake and eat it.
Fundamentally, they need to move.
It's prudent to kind of take it one step at a time.
The chances of 75 appearing later in the year is zero. Don't rule anything out.
Joining us now, Lisa Hornby of Schroders, Jonathan Golliver, Credit Suisse. Lisa, first to you. What changed for you in the last 24 hours?
Well, obviously, the 75 basis points off the table was the major change. I think the irony yesterday is that Powell increased rates 50 basis points. They announced that they're going to start QT soon, and yet they actually loosened financial conditions on the day with the market moves. And I don't know that was entirely intentional, but that is a big shift, right? They're taking off some of the very, very hawkish rhetoric, at least in the near term. And I do think that it removes the probability of a Fed-induced policy recession for at least the time being. I think that was something the market was a bit concerned about, and you saw that risk being taken out of the market to some degree yesterday.
Lisa, you effectively clarified the rate path through the rest of the summer. Are you comfortable? To what degree are you comfortable, with any degree of confidence do you have right now, over whether rates have peaked at the front end for the time being?
Yeah, I do think there is some more certainty in the near term, as you say, Jonathan. I'm not entirely confident that Bullard won't come out tomorrow and take some of that back. just given the nature of his comments more recently. But, I think markets like certainty, and the fact that we now, it does seem reasonably certain that it's probably going to be 50 basis points for the next couple of meetings. I think that's a good thing. The market has discounted a lot. The hard part now is if the Fed is going to be a little bit less aggressive in the inflation fighting, then that means they will ultimately have to hike more over time. So it may not be in the next 2 or 3 months, but over the next year or so. I do think we probably have 80% of the rate move priced in. We're probably in the latter stages of it, just given, markets discounting a 3.25% terminal rate. But, there could be another 25 or so to go in there.
John, you've made a move. You've cut your price target overnight at 4,900 from 5,200. I don't think that's the news, though. I think the news is you still see 14% upside or so in the equity market. So let's talk about that. Why do you still see so much upside in this equity market for this year, John?
Well, I think if you look at stock returns over the course of the year, it's not the 10-year bond yields alone that's been driving multiples lower. It's the fact that the VIX has blown out and credit spreads have widened in an environment where recessionary risk is still really low, where credit performance, that means basically people are paying their loans, but the credit spread is widening. And in those environments, the credit spread tends to come back in. So of the 13% that we expect between now and the end of the year, I guess with the futures down, it's 14%, but a little bit less than half of that is just better earnings. The earnings are coming in great. And the other portion is a tightening of credit spreads and falling vol. But financial conditions are different than they were at the beginning of the year. The pace of the Fed move is going to be more than we expected on January 1st. And that means some of the loss that we have this year, we're just not going to get back.
Your call on earnings, let's talk about that. It's pretty constructive, John, going through it. 12.2%, 8.5% growth for this year into next year. What's behind that, John, and what do you think others are missing who disagree with you?
Well, it's interesting. So for all of this rhetoric that earnings are going to fall apart because margins are going to be a problem, the analyst estimates are going up right now at a pace that indicates that my numbers are perhaps even too low. So the analyst estimate revisions are very, very strong. Year to date, the forward estimate on earnings is up about 6% in 4.5 months. That's a fantastic number. And it comes down to one thing, nominal GDP, because that's what we care about when we care about earnings. That's GDP plus inflation is expected to be 9% this year. That's going to drive double-digit revenues. And in an environment where revenues are really strong, you just don't get margin declines. And the reason is because companies have a lot of fixed overhead. So even though costs may be going up, not all of those, there's other expenses that are not going up. Your leases, your depreciation, things like that, which stay stable. So it should be a pretty robust earnings environment.
Futures right now pulling back 0.9 on the S&P, down 1.2% on the Nasdaq, about 25 minutes away from the opening bell. The Fed's behind us, the payrolls report in front of us. Mike McKee staying down in Washington, D.C. for us. Mike McKee, good morning to you, sir.
Good morning, John. The number that stunned everybody this morning was non-farm productivity falling at the most, by the most since 1947 as unit labor costs rose significantly. That may be a bit of a one-off. And a lot of analysts are looking at the jobs report for a clue to whether things get better, because it presents an interesting conundrum for the Fed. We may be running out of people to hire. In part, the labor force hasn't recovered from the pandemic and may not, and a lot of people are retiring. So you look at the number of jobs forecast for the month of April, it is lower than we have seen since almost the beginning of the pandemic, with 1 month exception if you leave out the big spike and jump back. Unemployment will drop because there's fewer people maybe coming into the labor force. The participation rate's still below where we were before the pandemic began, and so that pushes earnings up, and all that is something that the Fed doesn't particularly want to see, because it does imply more inflation ahead. And you can see there how we are getting more inflation in terms of productivity falling and the unemployment rate dropping as the number of people working does not keep up with the demand. With 11 million job openings, we're still going to have problems going forward. And it suggests a labor shortage ahead that will push up average hourly earnings, add to inflationary pressures, but at the same time, it might make it easier for the Fed because the labor market is so strong, and this is a case that Jay Powell made yesterday, that they have much more room to move and less scope for sending the economy into recession.
Mike McKee, looking forward to catching up with you several times through the next 24 hours. Lisa Hornby, I want to come back to you. The Fed has cleared the decks in many ways. They've suggested 50 again, 50 after that, reassess after summer. With that in mind, Lisa, how do you think we're going to respond to incoming information, incoming economic data, including tomorrow and through the next couple of months?
I mean, I think inflation data still rules the markets at the moment. I mean, the Fed is under obvious pressure to get the inflation genie back into the box. I mean, I think Powell's address that started out almost to the public at large yesterday was testament to that. He understands the problems that people are facing. Inflation is a problem that hits everyone, particularly the lowest income. So that's the major driving force for me. Do we see, or have we seen inflation peak? In our view, we're probably pretty close to that peak. Some of the supply chain data that we look at suggests that perhaps some of the worst levels are now behind us. Inventories are starting to be rebuilt. So if that is the case, then that does clear the way for a slightly more constructive view going forward. I think that the big question is what happens to the next 2 to 3 months CPI data, and is it 50-50 and then a series of 25s, or is it 50-50 and then we're back to 75 on the table again?
Just as far as peak inflation is concerned, Stuart Kaiser of UBS agrees. He says the following: peak inflation, hawkish rates pricing, recession fears and like positioning tilt risk-reward positive, but we're only in step 1 of 3, and the path from peak inflation to a less hawkish rhetoric and lower recession risk might be further down the road. But ultimately the call here, John, from UBS is to buy the Qs, the Nasdaq 100 ETF. We had a massive squeeze yesterday in tech. John, I want to understand your interpretation of that. Was that trades coming off or trades going on? Shorts off or longs on? And how comfortable are you telling clients to get long big tech again?
Jonathan, I'm going to be really reluctant to comment on anything that happens in the market internals on a day when the S&P is up 330 basis points. So is it possible that you had some kind of a short squeeze on some tech shorts or something else? Who knows? But there's a couple of things on technology. First, tech stocks were insanely expensive at the beginning of the year, and the correction in tech and growth stocks they're still expensive, but they're nowhere near as nosebleed as they were at the beginning of the year. They're starting to look a little bit more investable. We've been neutral on them. We continue to be. And the other story is during earnings season. So that's a positive thing on valuations. But the other thing is, for some reason, the big tech companies did just awfully this earnings season. I mean, this was a terrific earnings season across the board, except for the biggest tech names. And that is you can measure it in beats or were minuscule. Their growth rates were negative. So I'm not sure that we have a green light right now in technology. And I do think that if the Fed was signaling that they are a little bit more reluctant to beat up the economy, then you probably want to be in cyclicals. Companies like energy, in areas like energy and materials that actually do better from an overheating economy. And I think that that's actually what we have. We have an economy where, even if Lisa's 100% right that we peaked, in the last print or the next one's to peak, whatever that is, we're still talking about really, really low interest rates and really high inflation and growth rates.
John, let's come back to that in just a moment if we can, because that call on cyclicals is something we want to talk about, the energy story as well. Jonathan Golub, Lisa Hornby, going into the opening bell about 20 minutes or so away. Equity futures gapping lower over the last 20 minutes or so. We're down 0.9% on the S&P 500. A reversal, just a small one, of the move lower we saw yesterday in yields. Just a bit higher today at the front end by a couple of basis points to 266 on 10s by 4 or 5. Just short of 3% at 298. I want to turn to the stocks to watch ahead of the the opening bell. Let's get to Taylor Riggs for more. Hey, Taylor.
And John, some fundamentals here, right? So let me walk you through this. Actually, one to the upside. Albemarle, of course, one that we're walking about. Top and bottom line, big boost there. Analysts really liking the stock this morning. Talking about the pricing for lithium. KeyBank, Wells Fargo saying that that is not going away anytime soon, given the big demand for EVs. Shares are up about 13%. Corvo's an interesting one. I guess we'll say unch on the day, but really this is the story of the chip haves and the chip have-nots. AMD was great. Qualcomm was great. Corvo, of course, though, sort of missing here on the bottom line and really looking at some big supply chain issues that we have here coming from China. We also have some e-commerce plays here, John, and Etsy is off 13%, really struggling yesterday after the bell. The forecast going forward, missed estimates. Is this all sort of us getting back outside? Truist Securities saying that's a big macro headwind. When you think about some of the big reopenings, similar story here with eBay, John. You're off about 6% in pre-market. The e-commerce companies saying that slower online shopping, and of course, they're coming up on some of the big comps when you think about the big pandemic sales boost. Some of that, John, now starting to fade.
Taylor, thank you. Taylor Riggs with us through the opening bell. Coming up next on this program, JP Morgan's Jamie Dimon warning about the fallout from the war in Ukraine.
I hate to guess the future. No one really knows the future. I've never seen anyone really guess it well. But again, if Ukraine gets worse, I would assume that Europe's going to go into recession. It may take a couple of quarters, but I would assume that.
The latest on sanctions next.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
In my view, the most important thing is American growth, and that America, I call it this Marshall Plan for energy, that we do everything we can, and this doesn't violate climate change, it doesn't change anything about long-term objectives, but that we do everything we can to get oil and gas into the hands of Europeans so they don't freeze in the winter. And again, I'm not saying it's going to happen, but you have a couple of problems out there. The national energy stuff is, the global energy is precarious.
Jamie Dimon there, sitting down with Francine Lacqua in the last 24 hours. Bit of breaking news just moments ago. This from CNN. The Biden administration plans to seek bids this fall to buy 60 million barrels of crude oil to replenish America's shrinking emergency oil reserves. Crude straight up by 3 percentage points now to 111.11. Let's get some coverage of this story with Will Kennedy in London, Anne-Marie down in DC. AMH, first to you. Your thoughts on this reporting from CNN just moments ago?
Well, it makes sense, Jonathan, right? That the Department of Energy is going to have to try to refill some of the drawdown they have off of these stockpiles of the SPR. They've now tapped it 3 times, this administration. So it would only make sense to want to refill that emergency stockpile. It does take a lot of time, though. So if they're going to announce this week, you're not going to see that in months' time.
What can they do, Anne-Marie? Because right now, crude's going the wrong way for them again. And clearly at the pump, the gas prices haven't changed too much either. What's left?
Yeah, I wonder if some politicians who, during the 2020 pandemic, when the Trump administration wanted to buy oil, WTI, when it was 30 and going lower and then negative to fill up the SPR, they said no, because this would be a buyout for the oil and gas industry, are wondering if that was actually the right move. Because if you're going to fill up the SPR, you're going to be filling it up at a time when it is very expensive. But this does give a little bit more of an influence and a nudge and maybe a push to the U.S. oil and gas industry in the Permian Basin to want to put investments into their work and try to get production up right here in America, because they know for sure they're going to have a buyer, and that's going to be the United States.
A bit of news elsewhere as well. I just want to draw your attention to, and then we'll return to this story a little bit later with Dan Ives of Wedbush. But on Twitter, CNBC reporting just moments ago that Elon Musk is expected to be temporary Twitter CEO after the deal closes. The conversation we'll have with Dan Ives of Wedbush a little bit later is whether this deal can close if the financing is secure, because right now in the pre-market we traded about 50 going into the opening bell. As you know, the offer price is $54.20. That's the agreed price, so about $4.20 a doubt, $4 or so of doubt right now. I'll get back to that story a little bit later. Will Kennedy, I want to talk to you just briefly over in London. OPEC Plus had a meeting. We've seen them before. They don't last very long. Did this one last long?
13 minutes, John.
Isn't that embarrassing, Will?
It certainly is perfunctory, and I think it's really important to say that with so much going on in the energy world, with the EU embargo yesterday, with their sanctions on shipping, with the massive SPR releases we're seeing in the US, OPEC is absolutely on the sidelines here. They are not part of the conversation. They have not altered their policy 1 inch. Since the war. Now, they have their reasons, but I think it's an incredible contrast with 2 years ago when OPEC was absolutely the center of things. We had price wars, we had negative oil, we had grand bargains between Washington, Riyadh and Moscow, that it's not part of this market right now. And that's partly because it suits them politically, but partly because they don't have any firepower.
Well, I have to admit that I had to Google perfunctory. And for those that might have to do the same thing, carried out with a minimum of effort or reflection. Will, thank you for that. And education, as always. Will Kennedy over in London, AMH in DC. I want to bring back in a guest, Lisa Hornby and John Golub as well. John, we touched on this just briefly about the cyclicals trade. I want to understand from your perspective where energy fits into that.
Oh, it's at the very top of the food chain. It is absolutely our favorite group, and there's two issues. One is we have restricted energy production in the name of sustainability, and I understand that the same way that Jamie Dimon was saying that he's a fan of sustainability issues, but right now we need to go and pump more oil because there's a demand for it. And also, in a very strong economy, you move more goods and services, more people go on planes, you produce more goods, and all of those things use more energy, and therefore we're looking at an environment where the energy sector is the cheapest sector of all, and their earnings prospects are not only good now, but are likely to remain pretty strong until we resolve some of these transition issues to new energy sources.
Lisa, where does this leave break-evens in the bond market from your perspective?
So I do think that if the Fed's a little bit slower, then break-evens probably do rally a little bit more. I think we're at the end of that trade, generally speaking. I think real yields are probably more important here. But, I do agree structurally with Jonathan's comments that oil and commodity demand is well supported. I think that goes beyond just the near term with regards to Russia and Ukraine. But, as Jonathan said, the ESG movement means that we need to get these commodities out of the ground to power the battery and electrification movements that we're all looking at in the next 20 or 30 years. So that's a very supportive backdrop. And I think back to your question about break-evens, that means that inflation is probably structurally a bit higher than where it was pre-COVID. I think the Fed has articulated that they might be comfortable with a north of 2% inflation target. I think they may well get that.
Would you go one step further? 3%? Would you go 2 steps further? Would you say they're comfortable with 4? They're not going to tell us that, but is that implicit in what they're telling us right now?
I think near term, they would probably be thrilled with 4%. I think over the longer term, these are all kind of lines in the sand. I've read once, I think the 2% target, I think, came from the Bank of New Zealand, and it feels fairly arbitrary. But, whether it's 2.5 or 3, I think the Fed's probably comfortable near term overshooting that as long as the direction of travel is down. I think that's the most important thing to think about from here to the next 6 months. And then further out, 2.5 or 3%, it's sort of guessing at this juncture.
I think we're all guessing at this point. Lisa Hornby, Jonathan Golub, thank you very much. Coming up in the morning calls and later, Chris Harvey of Wells Fargo looking to break evens to guide his outlook. We'll catch up with him. And then Dan Ives of Wedbush. The CNBC reports that Elon Musk is expected to be the temporary Twitter CEO after the deal closes. Some might say if the deal closes. We'll have that conversation in just a moment. Equities absolutely rocketing yesterday on the S&P, up by almost 3%, on the Nasdaq by 3.2. Futures pulling back on the S&P 500 by 0.9%. Your opening bell just 7 minutes away.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
We got a big pop yesterday and a pullback today. We're down by about 1% on the S&P. On the Nasdaq, we're negative 1.35%. In the UK, we've got an absolute mess we can touch on a little bit later, with upside risk to inflation, downside risk to growth, a set of forecasts from the Bank of England that sees double-digit inflation year-end and a contraction in GDP next year. That's a problem, and there's a problem in the FX market too. I'll touch on that a little bit later. So that's your price section. Here are your morning calls. First up, D.A. Davidson cutting its lift price target down to 27, saying the company needs to invest in additional drivers and better marketing. Argus downgrading Twitter to hold, citing valuation following the stock's recent rally. And finally, Baird cutting its price target on eBay down to 65, expressing concerns about the company's guidance. Coming up, Chris Harvey of Wells Fargo joining us for the opening bow, telling clients to put money to work with the S&P below 4,300. That conversation is just around the corner, with futures negative on the S&P, on the Nasdaq, on the Russell, on the S&P 500 down by 0.9%.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
24 seconds away from the opening bout this morning. Good morning to you all. This Thursday morning, 24 hours, 23 hours away from payrolls. Equities pulling back from yesterday's monster move higher, down by about 1% on the S&P 500. Futures negative on the Nasdaq by 1.4. On a Russell, down a little more than 1 full percentage point. There's the opening bout. Switch at the board and check out the bond market all over the place. At the front end, the long end, throughout the whole Treasury curve. Today, back up 8 basis points and back through 3 percentage points on a US 10-year. The dollar showed a bit of weakness off the back of chair power yesterday, now showing some strength against the euro. Euro dollar 105.61, negative 0.6%, and sterling earlier getting absolutely crushed. Looking at some of the opening moves then in the stock market, let's get over to Taylor Riggs for more. Hey, Taylor.
You know, John, I want to take a look at shares of Etsy again and Wayfair. We've been talking a lot about e-commerce stocks this morning, not only the year-over-year comps that they have to digest, but of course, sort of when yields are rising, how you're thinking about growth at any cost. Indeed, Etsy, of course, disappointing guidance, already down about 50% year-to-date. Wayfair, similar story, really worse than expected adjusted loss per share. Again, 52% loss for this year alone. Royal Caribbean's interesting. The revenue broke $1 billion for the first time in 8 quarters, but it still was sort of a big loss on the bottom line and still waiting for that big rebound in travel. The CEO saying inflation and yes, supply chains still continue to weigh on some of that full year earnings guidance. I have to do it. It's Twitter. You're up about 3%. John, you mentioned the breaking news, of course, earlier about being a temporary CEO. Elon Musk, at least on a balance sheet income statement perspective, finding an additional $7 billion worth of financing. So that would bring his margin loan, his bridge loan down from about $12.5 billion to about $6 billion, perhaps maybe in theory making this a little bit less risky and bringing in some big buyers. I think Fidelity, Brookfield Management, Larry Ellison, formerly over at Oracle, so bringing on some big names, Qatar as well to help him out.
Might be great news for Twitter shareholders. I don't know about Tesla, though, Taylor. And also, what is it about this stock, this name, and part-time CEOs? Wasn't Dorsey the CEO of multiple companies a few years ago, Square?
Really good point. I think that maybe Ed Ludlow, who knows the story better than I would say that if anyone could do it, it is Elon Musk. He's been running multiple companies for multiple years. Really hard to bet against that guy. But you're right in terms of maybe that's why it's temporary instead of full-time, where they wait for a full-time position.
Taylor, awesome. As always, great to catch up with you. About 2 minutes in, we're down about 1.1% on the S&P. Yesterday was just a monster move. The biggest one-day pop on the S&P 500 going back to 2020. Is that rally from yesterday sustainable? Big question, Katie Lyons. No one really knows the answer to that at this point.
No one knows the answer, John, but it also doesn't really look like it this morning, considering you are seeing a reversal in risk sentiment. Not only was it the best day for the S&P 500 in about 2 years yesterday, it was the best performance on any Fed day going back to 2011 and on the best performance on the day of a Fed hike going all the way back to 1978. Because yes, this did indeed come even in the face of a 50 basis point rate increase and the promise of more of that size coming in meetings. So how dovish was this really? Was this just a market that had gotten ahead of itself in terms of hawkish expectations and the idea of a 75 basis point hike? I would point to Cameron Price and his Macro Man column out on the Bloomberg terminal today saying just because it's not getting worse doesn't mean it's going to get better. And of course, it has not been good for equity or bond markets in the anticipation of tighter policy. The S&P 500 down more than 10%, nearly 11% year to date. For the NASDAQ 100, that big tech index, it's been much, much worse, down 18.5% at this point. And of course, that has a lot to do with higher yields. We're up 150 basis points on the 10-year Treasury just year to date, and real yields are back in positive territory, which of course puts pressure on high multiple growth stocks in particular. When you put all that together, higher borrowing costs, the pain in equities, collectively, it has had the effect of tightening financial conditions pretty materially. When you look at the Bloomberg Financial Conditions Index and kind of take out the pandemic panic of 2020, this is the tightest we have seen financial conditions going all the way back to 2018. And in theory, as the Fed continues to hike, as QT gets started in June, that should be the case, although it certainly wasn't the case yesterday, John.
How things change, how quickly they change, just like that. Just a couple of comments about 75 basis points. Katie, thank you. Thank you very much. Perhaps tells you more about where we were than where we're perhaps going in this equity market, where we were and how much we were priced in this bond market. Goldman's Peter Oppenheimer is pretty bullish, constructive. Take a listen.
We are bullish of equities on a relative basis. We've got reasonable upside into the modest double digits over the next 12 months in most equity markets, because we think some of the tensions that investors are clearly focusing on and some of the uncertainty about where rates will peak and how weak economies will be will start to fade over that period.
Joining us now, Chris Harvey of Wells Fargo. Chris, fantastic to catch up with you, buddy. I was just reading through your note. The focus shifts from real rates to break-evens. This is a bit different to what I heard a little bit earlier in the show, Chris. Just explain it and we'll work through it together.
Yeah. So John, as you know, we've been talking about real rates normalizing for some time, and they have. And the thought process was as real rates would normalize, cyclicals value would begin to work, and those growth at any price type stocks would really start to roll over. And that's more or less occurred. Now, the reason why we're shifting from a focus from real rates to break evens is if you look at real rates, they're no longer at a tail, right? They were historically low for a long period of time. Now they're back to zero, and we don't have as much information there. But when we look at break evens, we have a lot more information because they're at multi-decade highs. And one of the things that we're beginning to say is, hey, we're going to use break-evens as a guide for growth. If we start to see break-evens, quote-unquote, break, we think that's very good for the growth style and growth investors. But until we see that break, it's still going to be tough sledding for them. And the reason why we want to see it to break is because if it does, what that means, monetary policy is really starting to influence the market, really starting to impact the economy, supply-demand starting to come back in line. In other words, the economy slowing down, and that's better for growth.
Chris, do you have ranges in mind that will indicate when to make a shift one way or the other?
Yeah, so what we want to see on a 10-year break-even, we want to see that range of 250 to 275. Once we start getting down below 275, I think that's a pretty good indication that monetary policy is beginning to work, and that's a good time to start to move back into that growth side of the equation. We think sometime over the next couple months, we should start to see that, right? Monetary policies just started to tighten. But that impact should begin to be felt relatively shortly because markets have already priced that in very aggressively, very quickly.
Chris, this is a compelling framework. Have you back tested it? Has this worked over the last year or so?
Well, so the answer is your definition of back testing. Have we looked at it and has it worked and has it shown an indication? We've looked at our growth at any price type portfolio. We've looked at our reopening portfolio. And we correlated that to real rates. And there was a very key connection between those, all those relationships. As real rates went higher, what we saw is that cyclical portfolio or that reopening portfolio did outperform. As real rates went down, vice versa, and the same thing for growth. With regard to break evens, we haven't gotten that far because we don't have as much information and as much volatility. Break evens have more or less been in an upward trend and steady. But again, what we're thinking is, for the most part, the information is in the tails. And now we have break-evens at a multi-decade high. We have reals off the lows, and so now that should be the focus. And that's going to be an indication of when monetary policy really starts to to have it really starts to infect the economy and really starts to show its teeth.
Chris, I had one Bloomberg subscriber just write in who would like to know what maturity you'd be using. Is one a better indicator than the other for what you're looking for?
Yeah. So a lot of people have different views on this. We're pretty simple. We look at 10-year break-evens. It's pretty stable. It's longer term, and we want that longer term stability. A lot of people will look at fives, and they'll look at various other issues. We simply stick to the 10-year because that's been a pretty good indication, a very stable indication of inflation expectations.
Chris, given this approach, are you de-emphasizing your index price target for year-end?
No, John, as we talked about, I think early in this year we said the equity market was going to break, right? This belief that the market can always bend but never break, that was a fallacy. That had to fall apart. That did. We came into this year, I think we were third lowest on the street at 47.15, right? We were the bull last year. We're pretty comfortable there because what we're calling for is a flat to down market. We don't see a recession, right? So if we thought there was a recession, we might reevaluate, but we don't see a recession because there's not the same bad actors that you saw back in 01 and 08, right? The consumer, you can say as much as you want about the consumer, but balance sheets are good and they're in a pretty good spot. You can say what you want about corporations, but I don't see a WorldCom. I don't see things blowing up, and there's a lot of cash on the balance sheet. And the last thing I would say is banks have gone through the best stress test you could have ever designed for them. They went through the pandemic recession. And so we just don't see a recession materializing in the next 12 months. And with that, we're going to keep that 47.15. And we do think there's upside. We're not bullish, but we think you can make money to the upside.
4,300 is a number that you've had in mind as well. Put money to work when we're below 4,300. Why is that number so important when we're at 4,250 right now, Chris? What's special about 4,300?
John, there's nothing special about that number. We were just saying we're looking for a 10% correction. At a 10% correction. When you get that 10% correction, you've taken a lot of froth out of the market. One of the things we also wanted to see multiple compression. We got that multiple compression. And at this point, if I said sentiment was bad, that's an understatement. Sentiment is horrific, and especially with growth managers. If you're a growth manager from the long-only side, you're down 20, 25%. This is not a good day. This is not a good year. And one of the things that we like to do is we like to go against sentiment. So at this point in time, it's not that things are great. It's just we think things are overdone. You've gotten rid of some of the excesses, and the underlying fundamentals are still relatively good for now.
Hard to read into the price action of the last 24 hours, Chris. In fact, the price action post-Fed has been pretty misleading. I'm thinking back to March 16th when we had a massive rally in the NASDAQ and then got absolutely hammered through the whole of April. Yeah. But what are your thoughts on what we've experienced in the last day or so? Do you think this was just trades coming off, shorts coming off, or longs going on? What was it for you?
Yeah, it's a little bit weird. I'm in a similar camp to you. Everyone was expecting a post-FOMC rally. And at first we got it, we didn't get it, we got it, we didn't get it. And then Powell came out and said, yeah, 75, not on the table. And the party started. Things just really rallied. What we saw is from the derivative side, we did see prior to this people putting on upside calls on the belief that I want to be careful if there is a pop. I think part of that was that. I think sentiment, as we talked about, is really, really poor. And so all you needed was a little bit more certainty. And what you got was a little bit more certainty, and you took some of the tail risk off. We can argue about whether it should be 3% or 2% or 1%, but I think it should have gone higher. Looks like as of today's action, it was a little bit too strong, and that's fair. But at the end of the day, I think you can now make money from the upside where I couldn't say that at the beginning of the year.
Let's see if that party continues. Chris, wonderful to catch up with you, sir. Chris Harvey there of Wells Fargo. We're about 11, 12 minutes into this. We are pulling back on the S&P by 1%, on the NASDAQ by 1.7%. Coming up, the volatility in big tech continues.
There is a very big dispersion in the U.S. tech stocks. You know, like you have a sort of mega cap tech, like a high quality names at the top of the index, which only saw some moderate correction so far. On the other side, you have what we call high beta tech, smaller cap typically, which are down 70%, 80% in some cases.
That conversation plus Elon Musk securing new financing for his Twitter deal. That conversation just around the corner with Dan Ives of Wedbush.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
There's a very big dispersion in the U.S. tech stocks. Given all the uncertainty, we actually prefer stuff that is down a lot, So we think like if there is some relief beat on inflation, beat on yields, you can have the high beta segment of tech rally a lot, Mega Cap will probably do in line with the markets.
Marko Kolanovic there of JP Morgan, just building on his outlook for big tech and this market more broadly. On tech, Elon Musk bringing a new set of players into his Twitter deal, securing more than $7 billion in new financing and cutting his margin loan. Bloomberg's Taylor Riggs is back with us for more. Hey, Taylor.
John, I think what's interesting, you're getting a little bit of an increase here in shares, up 4%, but ever since that deal was announced, you've never really closed except for one day above 50. You had on April 25th at 51.70 a share, but we're not coming anywhere still close to about a 54.20. So trying to get there again today, and this would be near the highs that we've seen since that deal was announced. Let's dive deeper into some of the news that we got this morning. Of course, about $7.1 billion in new financing. Lots of investors, Binance, Brookfield, Qatar, friend and board member Larry Ellison of Oracle, so certainly bringing in some new partners, cutting down his stake, that margin loan to 6 from about $12 billion or so, doing some rounding estimates there for you, John, but you get the picture. I think what is interesting is, of course, since that deal was announced, you've seen that it's been that tight trading range. We're hovering between 46 and 51. Again, not even getting close to even $52 a share. We'll have to see what today's news brings as well. That further news, as you mentioned, maybe a co-CEO in the interim.
Taylor Riggs, fascinating to follow, that's for sure. Taylor, great coverage as always. Dan Ives says this over at Wedbush: bringing Ellison and others on board to help fund the Twitter deal is a smart poker move that will be well received by both Tesla and Twitter shareholders. Dan Ives joins us right now. Dan, can we start there? Why both Tesla and Twitter shareholders?
Well, for Tesla, if you look, Musk, in terms of leveraging his share in the overall ownership stake of Twitter, basically being financed on Tesla's stock, taking less of a burden from Musk is a positive in terms of what he's ultimately down the road going to have to put up from Tesla stock. We also think the equity financing, he'll bring in partners, at least for probably 30 to 40% of that. So that's bullish because that's ultimately been about $100 per share overhang in Tesla stock. In terms of Twitter, because at this point, I'd say 75, 80% chance a deal is going to get done. Now, probably 95% plus, because you bring in these partners, Ellison, Fidelity, Sequoia, and others. I think this just shows this was the missing piece in the puzzle for the street.
So you're highly confident he's got the financing now, Dan. What's the 10% that's left? What's the 10% of doubt you've got?
Look, I think you see just a little arb spread here. It's just there's going to be twists and turns from a regulatory perspective. I mean, obviously, this is going to get a big focus both in the Beltway as well as Brussels. There is some. There's only about $1 billion breakup fee, for him to walk away. It's small, but I do believe relative to today versus yesterday after this news, it feels more like this deal is on a glide path to get done. And I think it also just shows from a Tesla perspective, it's not just Musk trying to fix Twitter himself. I mean, you're going to have Ellison, Sequoia, and obviously Brookfield, Fidelity, and all these others. They'll have their teams, even though it's passive, called strategically help.
Yeah.
Because again, for Musk, the easy part was buying Twitter. Hard part's going to fix it.
Dan, this is the financing. Let's talk about the fixing and the management. CNBC reporting this morning that Elon Musk is expected to be the temporary Twitter CEO after and if this deal closes. Dan, what do you make of that?
Look, I think it's one that there was a good chance this was going to happen. I ultimately do believe that he ultimately moves more to a chairman role than not as a permanent CEO. I think obviously the fact that he's putting up basically 20% of his net worth, to buy Twitter. I mean, it's not a shock, but it also goes back that we saw with Dorsey, we've seen with others. Musk is the heart and lung of Tesla. So any distraction for him, I mean, that's going to be ultimately micro-analyzed in terms of just taking an eye off the ball. I believe he'll be able to manage it, but clearly you don't want to see him as a permanent CEO of Twitter.
Well, let's talk about whether he would be. And if you've got a decent picture of what he's going to do with this name, it's been widely reported, and most people speculated that once it went private, it wouldn't be too long before it became public again. Dan, have you got a decent idea for the trajectory of how you think this plays out, the timeline for it?
Look, I think this is going to be an Everest-like uphill battle to fix Twitter. I mean, remember, relative to also what he's paying, no one's going to get within, a football field of that price relative to the $54.20. He's going to have to transform. It's going to take years, 2 to 3 years. Subscription model, the advertising, the algorithms, the free speech. That's going to continue to be a tightrope. Social media arms race. Twitter has basically been in the right lane, missing out, where others pass them in the left lane. So I think this is going to be uphill battle. I would not expect this to get back out in the public markets for a number of years.
Dan, Taylor Riggs mentioned earlier, and she's right, that Elon Musk has proven that he can manage several different companies. He's had success with many of them. Tesla, of course, first and foremost. Can you tell me, as someone who covers Tesla, when all of this starts to become a little bit more problematic for you, are we there yet? If we're not, what would it take?
Yeah, we're not there yet. And I think Musk, the golden child for Musk continues to be Tesla. But between the build outs of the Giga factories in Berlin and Austin, and of course what's happened in China, potentially a second factor there. You got autonomous FSD, Cybertruck. I mean, there's a lot on the plate in terms of Tesla. John, I would say if we go into the next, call it 12, 18 months, and you start to maybe see some hiccups, tripping over the shoelaces type things that happen at Tesla, that's where you start to get concerned. But as we know, I mean, he's had the golden touch. It's hard to ultimately bet against him. And ultimately for Twitter, I mean, this has been a treadmill stock for the last decade. So clearly he's going to improve it right off the bat. But it goes back to the easy part was buying it. The hard part is going to be fixing Twitter. It's a whole different animal than the technology companies of Tesla, SpaceX.
Dan, final word. I've got 30 seconds for you. April was a really tough month for you, and you've been open and transparent about it. Difficult. Run me through what you learned from the month of April, just as far as some of how these tech stocks traded, and what you're thinking going forward.
It's been a brutal month. It's been a brutal year. I mean, for any tech investor bull like ourselves, look, I think it's a have and have-nots during earnings season. I mean, enterprise, cybersecurity, cloud, demand for names like Apple, semis holding up strong. But it goes back to the work from home names, the e-commerce. Those are going to continue to sell off, and won't really touch any of those names. I think you got to own quality tech I still think what we saw with Powell, that's starting to put the bottom intact
in
terms of what we're seeing oversold. But no doubt, it has been, it's been a year so far where I think it's going to drive many to be drinking a lot of wine.
Don't do that, Dan. Stick with us. Stay sober. That's where we need you on TV. Sober, not drunk. Dan Ives of Wedbush. Dan, great to catch up with you, buddy. As always, your trading diary up next.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Well, yesterday giveth, today taketh away, something like that. I've butchered that, haven't I? You get the picture. We're taking yesterday back in a big way on the NASDAQ 100, down by 2.6%. That's the price action. Here's your trading diary. Payrolls report tomorrow morning. A host of Fed speak, including Williams, Kashkari, Bullard and Waller. Inventories next Monday. Fed speak, more of it Tuesday. CPI on Wednesday. That's the big one we're counting you down to after payrolls tomorrow. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that